particular. So I'm coming to use the question 3 to explain something. You see, mostly the NPV or the internal rate of return, anything that has to do with time value of money, you are going to be using a nominal discount factor or a discount factor in the money terms. The question will tell you that use the nominal discount factor. So the discount factor that we normally use to appraise the project should be the nominal discount factor, the one that takes into consideration inflation of the variables. Okay, but the question will not give you the nominal cost of capital, or they will not give you the nominal discount rate. They will give you the real one, which does not take into consideration inflation, and they also give you the general inflation rate. Then you have to now calculate your nominal cost of capital. How do we do that? We use what we call the Fisher's formula. So we use the Fisher's formula. So for you to know your nominal cost of capital, we use the Fisher's formula. Okay. We use the Fisher's formula, which states that 1 plus your real cost of capital will be equal to, so the only thing that can increase your real cost of capital, which is not in the money terms, is the inflation. So if you want to know the actual interest that you will be earning, you just multiply your cost of capital by the inflation rate. So which is equal to the 1 plus the inflation rate multiplied by 1 plus R, which is the real rate. So the question will give you we use the H is the general inflation rate, not the individual inflations over here. So these individual inflations will be used to adjust the fixed cost, the variable cost, and then the revenue. So those are like the one we did yesterday. We'll be using, so the question is saying that the selling price, the cost, and all those things are in their current terms. So every year you have to inflate the selling price by 3%, the variable cost by 4%, and this one also by 6%. Okay. So the question will give you the real cost of capital, which is 5.7%. Okay. So our real cost of capital is 5.7%. Okay. So we have 1 plus I is equal to 1 plus, then we bring the general inflation rate over there. Let's see what is the general inflation. So the general inflation is expected to be 5%. Okay. So you put 0.05 here. Then you multiply 1 plus 0.057. Okay. So what do? We do multiplication. Okay. So we are going to be having 1 plus R is equal to, then this will be like normal expansion, binomial expansion. So we have 1 multiplied by 1 plus. Okay. So let me just write all of them at once. Let me just put them together. So this will be 1.005. Okay, 1.0. I wanted to do some small mathematics there, but let's just put them together. Multiply by 1.057. Okay, then you now find this one by having R is equal to, you group like them, so the one will come there. So we have 1.05 multiplied by 1.057, all minus 1. Then the answer that you get over there will be the nominal cost of capital in decimals. Then you multiply by 100. If you multiply by 100, then that will be giving you the percentage. That is how we go about it. So the question will not give you the discount factor straightforward. The discount factor that we use is the nominal discount factor, or the discount factor in money terms, or the nominal cost of capital. So they can give you the general inflation rates, and they also give you the real cost of capital. You use the Fisher's formula to determine the nominal cost of capital. That is very important. Another thing that I'm going to talk about is, we know how to find tax benefits. We know how to do those things. If the question says that depreciation is included in the fixed cost, take the depreciation out of it. We do the tax benefits with the assumption that depreciation has not been subtracted from the profits. So if the question says that depreciation is included in the fixed cost, take the depreciation from the fixed cost before you put the fixed cost over there. Then you now go and do your tax benefit based on the capital allowance that the company will be enjoying from the tax authority. If the question says that depreciation is included in the fixed cost, they are using the depreciation by the company. How the company calculated the depreciation, that is what is included in the fixed cost. So if the cost of the machine is 100,000 and it's going to last for 5 years, the depreciation that is included over there is 20,000, not the depreciation that the tax authority is giving. No, it will be the depreciation based on the company's its own computation that is included in the fixed cost. So calculate depreciation on how the company is going to calculate it. If they have the residual value, they will take it from this place. So you calculate the depreciation on how the company is going to calculate it on a normal basis. Then you go and take it from the what? The fixed cost before you subtract. Then if you count the tax benefits, you will now use the capital allowance rates for the tax authority to know your tax benefits. Okay. Another thing that I want to talk about also is the inflation. If you look at the inflation for each of the items, okay, if you come here, you can see that selling price is what? Is 3% per year. So it means that every year will be 3%. You can get a question where the inflation rate will be different from each year. So maybe the selling price for the first year, maybe they can say the selling price in current terms is 10 cedi. Okay, this is in current terms. So they will say that the year one, year two, year three, year four. Then they will give you the inflation rate. Okay, they will give you, say, that year one is 3%, year two is 5%, year three is maybe 7%, and year four is 4%. Okay, for this one, we can't use that present value is equal to 1 plus R exponent n. We only use this one if the rate is the same for every year. So if you want to do this one, what you are going to do is that the year one price will be, year one will be 10 multiplied by 1.03. That will be year one. But how do we get year two? Year two will be 1.05 multiplied by 10.03. Why 10.03? It will be the year one's price that will increase by 5%. So you'll not be increasing each year's own what? Selling price by you do it one by one. You cannot do it the way we did it yesterday. So you find the first year's own, then you increase the first year's own by 5% in year two. Then you find a year two's own, then you increase it by 7% in year three. Then you find a year three's own, then you increase it by 4% in year four to get a year four. So you do it one by one. You can't use the formula for them. All right. Those are the basic things that I have to talk about before.
Yeah, Brian.
Yes, yeah.
What you were explaining, you see, when you started the Fisher's formula, you say 1 plus I is equal to 1 plus H, 1 plus R.
Okay.
In the second line, when you input the figures, you maintain it. But in the third line, you change the 1 plus I to 1 plus R. Is the R the same as the I?
Sorry. It's supposed to be 1 plus I. Yes. All right. So it's supposed to be 1 plus I. Okay. I hope we are clear.
Okay, yes.
Okay.
Yes.
So let's talk about how you can deal with. Please, sometimes the question can give you, they can give you a question that they will not give you the cash flow directly, but they will ask you to calculate the payback period. It means that you have to determine the cash flows yourself. So you do the same thing. You do your cash flow statement, revenue. You do the same thing like how we do it under the NPV. They can also ask you to find return on capital employed, but they will not give you the profit and those things directly, but they will give you revenue, or they will give you the items one by one, which you have to determine the revenue yourself. You have to determine the cost yourself. Then you prepare the profit statement. You prepare the profit statement yourself to know the profit for each year. Then you take the depreciation and find your average profit and also find your average investment. So they can do so many of those things. Okay, before we move on to sensitivity analysis, I want us to pick this particular question. Okay, question 6. Adam, are you there?
Yeah, I'm here.
Okay, question 6.
Question 6. Is it Brazil or Brazil?
You can just put your name there and read. It's a noun.
Okay. Question 6. Basrail Company is reviewing investment proposals that have been submitted by divisional managers. The investment funds of the company are limited to 800,000 in the current year. Details of 3 possible investments, none of which can be delayed, are given below. Project 1. An investment of 300,000 in workstation assessment. Each assessment will be on an individual employee basis and would lead to savings in labor costs from increased efficiency and from reduced absenteeism due to work-related illness. Savings in labor costs from these assessments in money terms are expected to be as follows. Year cash flows. So we have year 1 to 5. Then the figures are below. Then project 2. An investment of 450,000 Ghana cedis in individual workstations for staff that is expected to reduce administration costs by 140,800 per annum in money terms for the next 5 years. Project 3. An investment of 400,000 in new ticket machines. Net cash savings of 120,000 per annum are expected in current price terms, and these are expected to increase by 3.6% per annum due to inflation during the 5-year life of the machines. Basrail Company has a money cost of capital of 12% and taxation should be ignored. Required. A. Determine the best way for Basrail Company to invest the available funds and calculate the resultant NPV. A. On the assumption that each of the 3 projects is divisible. B. On the assumption that none of the projects are divisible. Requirement B. Explain how the NPV investment appraisal method is applied in situations where capital is rationed. C. Discuss the reasons why capital rationing may arise. D. Discuss the meaning of the term relevant cash flows in the context of investment appraisal, giving examples to illustrate your discussion. Yes, I'm done.
All right, thank you, sir. Okay, so this is the question that we have, and okay. So what is the available fund that the company is having? What is the available fund? What is the amount that they are having currently for the investment?
800,000.
Okay.
800,000.
Okay. The meaning is that you can undertake a combination of any project that will be more than what? 800,000. Okay, let's take the project one by one. If the question says that the projects are divisible, we use the what? The profitability index to choose which of the project we should undertake. Okay, so if the question says that the projects are divisible, then we use profitability index to determine the combination of the products. Okay, or the selection or the ranking of the product. But they say the project is indivisible, or the project is not divisible. What we do is that we can't use profitability index. We just select the project that are within our budget. Okay, so first of all, what we have to do is that we first of all have to calculate the NPV for each of the projects. You can see that you are not giving cash flows, but you are giving cost savings, isn't it? Okay. So the question is, if you are currently buying a fuel for 50,000 Ghana cedis every month, okay, and you decide to buy a new engine, that is 200,000. Okay, this particular new engine that you are going to be buying, if you want to replace your engine by buying a new engine of 200,000, this engine now will now be making you to what? To buy a fuel of 5,000 every month. You can see that the buying of the new engine is helping you to save a cost of what? The buying of the new engine is helping you to save the fuel cost of how much every month? Okay, that is helping us to 45,000. If you don't buy the engine, will you be able to save this 45,000?
No.
Okay, so you can see that the engine is helping you to maintain a 45,000. So this cost service related to the engine will be seen as a cash inflow. You are saving this amount because of what? The 200,000. So if you incur the cost of 200,000, you'll be getting a benefit of what? 45,000. So this will be seen as a cash inflow. So sometimes the question will not give you the cash inflows, but they will give you cost savings. The cost savings is if the decision is not undertaken, you will be spending those amounts. But if the decision is undertaken, those amounts will not be going out. So those are money that you are saving. They are cash inflows. They are money that you are not spending, or you are spending 50,000, but 45,000 is coming to you. So that will be as a result of the decision. So sometimes they will not give you cash flows, but they will give you cost savings. The cost savings are cash inflows. You have to take note of that. Let's come to the project A. The project A, the initial investment is what? So let's calculate the net present value for project A. That will be very simple. So they are giving us the cash flow. So what we do is we look at the project A or project 1. Then we have the years, we have the cash flow, we have the discount factor, then we have the PV. What is the discount factor given to us? 12%. Okay.
12%.
So our discount factor is 12%. Okay. So we are looking for MPV, isn't it? So now we are going to be spending 300,000 now. So that will be an outflow. The discount factor will always be 1.00. Then we now have the present value of the cost that you are spending is this one. So you have year 1. What is the cost savings for year 1?
That's 85,000.
85.
Okay. So that will be 85,000. Can you mention them for me?
Okay.
90.
85,000.
90. Year 3 is what?
95,000.
Okay. Year 4.
100,000.
Okay. Year 5.
And 90.
90.
5.
Okay. So what will be the discount factor? I should be using the discount. Let me try to get the table. So that I'll be using the table for you both so that you know how to use the discount factor table. Where is it? Okay. So I hope you can see the table, isn't it? You can see the formula and those things. Okay. If you are looking for the discount factor, this is a table for the discount factor. So you just the first one, if you open the book, if you go to the table, the first one is for discount factor. The second one will be a future value, like the compound factor.
Your screen is not showing.
Hey, really?
Yeah,
Linus, please, we can't see you.
Okay, you can see now.
No, please.
yeah, it is.
Yeah.
Okay.
Okay, it's now showing.
So I'm saying that after the formula, the first table that you see is the discount factor. It's for the discount factor, present value of a discount factor, like that 1 over 1 plus r exponent n is this one. So if you want a 12%, you just come to the 12th year. So this is for year 1, this is for year 2, this is for year 3, this is for year 4, and this is for year 5. So you just pick them over here. You just pick them over here and go and put it over there. If you check, you can see that 12% is year 1 is 0.893. It is 0.797. It is 0.712. Year 4 is 0.636. You don't have to point the calculator. You have to save time. So you just come to the first table over here and pick them. You just come to the percentage is at the top. Then the years these are the years over here. So you'll be seeing the years over here. So you just, if it is 5%, you count to year 1. Okay. But if you are using this particular formula, like how we do this one, present value is equal to 1 plus r exponent n. Okay. So this particular answer that you want to get over here, it is for the second formula. So that is for the second formula. Okay. So the future value of that particular 1 CD. So if you come here, you see that if you are doing, so these are the years. So if you are doing something like this, if you have something like this, 1 plus r exponent n. So let's assume that the r is 10. So you'll be having 1.1 exponent 5. Someone should do this on the calculator and approximate it to 3 decimal places. Then we compare with the one that we have on the formula here. So 1.1 exponent 5. What are you getting?
1.1. I'm getting 1.61051.
Okay, which is the same as 1.611.
Yes.
Okay, so what you do is you just come here. So this has already been done. So you just come to year 5 under 10%. This is the figure here, 1.11. So you don't have to, if you are doing the compound interest, you just write out the formula. Then you come here and see what is the rate that you are using. How many years are you doing it? Then you just come here. These are all on annually basis. They are on annually basis. If it is 6 months, then you have to calculate the 6 months yourself. These are all on annually basis. So if it is annually, you can just come straight forward to this particular formula and get your answer. Okay. Let's come to annuity table. So the annuity formula, the annuity factor. So the second or the third table is the annuity table. So if you want to find annuity, that is very simple. You just come here. So what percentage for how many years? So if it is 10% for 5 years, you just come to your 5 years over here. So you come to the 5 years over here. Then you come to the 10% over here. So this is the annuity for 10% for 5 years. That is it. If it is 50 years, you just calculate it over here and pick the figure. Okay. The second one is the future value. You see, the future value. This is for if you are doing ordinary annuity. Okay, if you are doing ordinary annuity, you know we write the formula like this. 1 plus r exponent n minus what? 1. All divided by r. This is how we write the formula. So this particular table, which is the fourth table, will give you the answer for this one if you are doing it annually. So if your rate is 1 plus 0.05, then you are doing 5 years minus 1, all divided by 0.05. You just come here to 5%. What is a 5%? Then you come to 5% under 5 years. So you just get your 5.326 over here. If you like, you can check to confirm. All right. So that is for that one. And I will try to finish this one so that I can take you through the formula so that you see how we use the formula. You don't have to memorize some of them. Okay, but if you practice more, it will not be a problem for you. Okay. All right. So let's get so for now you can use your calculator to get the discount factors for me. Okay. The first year is what? 0.893. Is that correct?
Yes.
Okay. The second year is what?
1.690.
Okay. 1.690.
Yes.
Okay. Please mention it again.
He said 0.797.
797.
Yes.
Okay. Year 3 is what?
0.712.
0.71.
712.
7.712.
Okay. Year 4.
0.63.
0.636.
36.
Okay. Year 5.
0.567.
567.
Okay, let's find the present value.
Yes. Yeah. Oh, well,
75905.
Okay. Year 2.
71730.
71.
730.
730. Okay.
67640.
67.
640.
Okay. Year 4 is what?
6367.
Okay.
53865.
Okay. So what will be the net present value? Are we having a positive or negative? I'm having 32740. Is that okay?
Confirmed.
Okay. So what you do is that you calculate the profitability index of this particular project. Okay. The profitability index is basically the present value over the initial investment. Okay. But sometimes they will not be giving the present value. So you can use the net present value divided by the initial investment. Then you add 1 to this. Or if you're not going to be adding the 1, then it means that you have to calculate all of them under the net present value over the initial investment. Okay, if you add the 1, it means that you are now, the cost is not subtracted from the PV. Okay, so the cost is included over here. But if you're using NPV now, it means that the cost has been subtracted before. So the cost is 1. So we are adding the 1 back to make it like the normal one. Okay, if you're not going to be adding the 1, then it means that you have to be consistent by calculating NPV over the initial investment over all of them. You have to be consistent in your formula. Okay, you have to be consistent in your formula. So what we do is we use the NPV, okay, we use the NPV over the initial investment, then we add 1 to it. But if you are not adding a 1, it means that then your profitability index calculation must be NPV over initial investment for all the projects. Okay, so let's count to the NPV. That will give you 32740 divided by initial investment of 300,000. Then you add the answer to 1. What are we getting for this one? You're getting 1.11.
I confirm.
Okay, let's go to the second project. Okay, let's have project B. Okay, project B, let's calculate the NPV. And so we do this if the project is divisible. If the question says that the project is divisible, we use the profitability index to rank the project. Let's count to the second project. Okay, an investment of 45,000 in individual workstations for staff that is expected to reduce administrative costs by what? 140,800 per annum in money terms for the next what? 5 years. Okay, so the cash flow over here is what? What is the cash flow? What is the cash inflow? What is the cash inflow? What is the cash benefit that the company will be enjoying as a result of this decision?
140,800
So every year for how many years?
5.
for 5 years.
So this is what?
Annuity.
Okay, so this is ordinary annuity, and you just have your years over here. You don't have to do year 1, year 2, year 3, no. Okay, so you have your cash flow, you have your discount factor of 12%. Then you now have your PV. So what you do is that you have year 0, you have 450,000 as the initial investment. Then you have 1.00. Then you now have 450,000 as the initial investment. Then you now count to year 1 to 5. You use annuity, 140,800. Let's calculate annuity for 5 years at 12%. What are you getting?
3.605.
3.605. Please, you can't be in this class and say you don't know how to calculate annuity. Okay, so let's count 140,800 times 3.605. I'm getting 507584. Okay, 7584. All right. So what are you having as the net present value?
I'm having 57,584.
Okay, 57584. Okay, let's find the profitability index. Okay, profitability index can be calculated straightforward from this one. This will be 507584 divided by 450,000. Or someone can use this and add 1 to the answer. What are you having? The third project.
Lanos,
Yeah,
can you kindly go to the project B for me? Let me check something. I didn't get the latter part.
I'm here already.
I said project A.
Okay. But you mentioned BO, senior.
Oh, okay, then A, the working sheet. Okay. Okay, that's fine. Thank you.
So I can move on now.
Yes.
Okay. So what is the profitability index for that one? 1 point. Okay. 1.13.
So please, the net present value, you wrote 5075. It's supposed to be 57. You added 0 to it.
Look at this one. You either use the present value over the initial investment, or you use the NPV over initial investment and add 1 to it. So if you use that one and add 1, you still be getting the same answer. So you can use any of them, please.
Oh, okay.
All right. I hope you're okay now.
Yes, please.
Okay. Okay. Let's go to the project C. Project C, what are they saying there? Okay, the project C, you are going to tell me how we should go about it. Okay. So project C, an investment of 400,000 in new ticket machines. Net cash savings of 120,000 per annum are expected in current price terms, and these are expected to increase by 3.6 per annum due to inflation during the 5-year life of the machines. How do we go about it? How do
So
we
the
do it?
project, what she was saying is right. You didn't get her right.
No, what she's saying is also correct. What I've also done is also correct. Okay, because
No,
what I
you
said
didn't.
was that you can either use the present value over the initial investment, or you use the NPV over the initial investment, then you add 1. So me, I know the NPV already. This is the NPV that I'm getting. This is a PV. This is the present value that I'm getting for the project. So it will just be PV over the initial investment. Or she can decide to use the 57584 and add 1 to the answer. She'll be getting the same 1.13.
Okay.
You can try that and see. All right. Sometimes you have to be very flexible in your thinking. If you are rigid like that, if you see a question, then it means that you can't think. So you have to be very flexible. Okay. Let's tell me how we should go about project 3. We don't have time. Fast. How do we deal with the project 3, Sinex?
Yeah, I want to try.
Okay.
All right. So the cash outflow is 400,000.
Okay.
For the year 1, the inflow is 120,000, which is the cash savings.
Okay.
And it will subsequently be increased by the inflation rate of 3.6 for the remaining 4 years.
Okay. Take this one. What you have said is okay, but the first year, so look at these statements.
You start from year 1.
So the 120 are expected in current what price terms. So this 120 over here is at the beginning of the year, but we assume that cash flows all arises at the end of what? At the year. So all cash flows will be arising at the end of the year. So at the end of the year, the 120 will still not be 120. So it will increase by 3.6. So the increment will start from year 1.
All right.
Okay. The increment will start from year 1. So let's do that, and so we have the years over here. We have the cash flow. We have the discount factor. Then we have the PV. The discount factor will still be the 12%. Then we have year 0. Year 0, I'm sure it's 400,000, isn't it? Adam, is it 400,000?
Yes, 400. Yes.
Okay. So year 1, this is what you are going to be doing. The cash inflow is 140, isn't it?
Right.
Okay. So what you do over here is you do 140 into bracket 1.036.
It's 120, not 140. 120.
Okay. So 120 into bracket this one. Okay. Year 2 will be 120. If you like, you can do workings for it and bring it. There's no problem. 0.36 exponent 2. Okay. Year 3 rather. Year 3 will give you 120 1.036 exponent 3. Year 4 will give you 120 1.036 exponent 4. So year 5 will give you 120 1.036 exponent 5. Okay. Please, sometimes they can give you residual values. The residual value will be added to the cash flow in the last year. Okay, if the machine will be sold at the end of the year, then the residual value will also be additional cash flow apart from the normal cash flows. Okay, so this one you don't have to take the calculator to calculate you have the discount factor over here. You can just come and copy these ones. You have them already. So 0.893, 0.797, 0.712, 0.636, 0.567. Okay, please, you can do workings for the cash flow before you bring them over here. But for me, I want to be time conscious. So I will just put it over here. You can put everything in the calculator and multiply by the discount factor before you approximate it. Okay, so you can do the 120 into, so you do the 1.036 multiplied by 120,000 times 0.893. I'm having 111018. Is that correct?
Yes, correct.
Okay. So you can do everything before you approximate the final answer. Okay. So let's do the remaining one and mention the figure so that we can move on.
Yeah, 2102650.
102.
Yeah, 650. Yeah.
Okay. Okay. Yeah, 3 is what?
$9,500.
9,000.
500.37.
Is it 95,000 or 9,000?
Oh, I'm not doing something right.
It's supposed to be 120,000 multiplied by 1.036 exponent 3.
Yeah, so it's nice. Okay.
This is 95003.
It's 95,000
Okay.
and 4. We are running to the whole number, so and 4. Yeah.
Okay.
95004.
Okay. What about a year 4?
7918.
The person should take it again.
87918.
87918. Okay. Let's look at the last year.
81,201.
Okay. So let's see what we are having now. Is it going to be a positive NPV? I'm having 77791. Can someone confirm that?
Yeah, I do.
Okay. So the profitability index will now be 77791 over the 400,000. Then you add 1 to it. What are we getting?
Okay. 1.194.
Okay.
Okay, 1.19.
Okay. So they say that we should do what? We should, based on the what? So based on something, we should, so based on the assumption that each of the 3 projects is divisible. Okay. let's come here. If the project is divisible, we use the profitability index to determine which project should be undertaken first. So looking at the profitability index, which of the projects should be undertaken first?
Project 3 or project C.
Okay, project C should be the first one. How much are we putting there?
Putting in 400,000.
Okay, okay. What will be the, we have 800,000. What will be the remaining amount?
400,000.
400.
So between project B or project 2 and 1, which of them should we take?
The second one is project B.
Okay, but the project B, how much are we going to put there?
400.
We can only put
350.
400 out of the 450. We don't have the total amount to be invested there. We have only 800,000. So if you are undertaking the project A, if you are undertaking the project 3, it means that you will be spending 400,000 there, remaining 400,000 out of the 800,000. So you can only put what? 400,000 into what? The project B. Divisible means that you can undertake part of the project. You can undertake part of the project. So if you don't have the money to undertake, or you can put the amounts that you have into the project, not necessarily the full amount. So if the project is divisible, what we do is that we are going to be undertaking a project that will be giving us the highest return. So that will be project 3 first. So project 3 will be giving us NPV of what? We are putting the full amount over there. So we are getting NPV. So let me put it one by one, project, and then the NPV. So we have projects. So we have project 3. The NPV was 77791. Okay, then we now come to project 2. Project 2, we have to invest what? All the what? 450,000 to be able to get what? The NPV of 57584. But we are only investing what? 400,000. So we find the 400,000 portion of the NPV. How do we do that? We just do the 400,000 over the total investment. The investment that you are putting there over the total investment multiplied by the what? The NPV that you are getting if you put the total amount there. 57554. What will be the NPV that we'll be getting? What is the NPV that you are getting?
5115.
51,000.
Okay, 511. Okay,
59.
This is
511
the NPV for the
1159.
is 584, isn't it?
yes,
Mm.
Okay, this is supposed to be 584. So 57584. Okay, so what are we having now?
Five one one 886.
Okay. So you just put the two together, that will be the NPV if the project is divisible. So if the project is divisible, you are going to be using the profitability index to rank the what? The projects. But let's come to if the project is indivisible. If the project is indivisible, the meaning is that you cannot what? Undertake part of the project. Okay. If the project is indivisible, we have 800,000. So we want to utilize all the 800,000. So what will be the combination of the project now? If the project is indivisible, it means that we can undertake parts. Okay. If the project is indivisible, we can also look at this. We can decide to undertake A, isn't it? We can decide to undertake project what? 1, which is 300,000. And it will be remaining what? 500,000. Okay, the 500,000 now, we can look at any of these projects. So we can look at any of these projects. So we can undertake the one with what? So you can see that we can undertake what? The project C. Because project C is giving us what? NPV higher than project what? Project 2. So if it is indivisible, this is how you are going to do the combinations. It can either be project 1 and 3, which will give you a total NPV of how much? It will be 7791 plus 32740. Let's look at that. What will be the total NPV? 32740 plus 7791. 77791. What will be the total?
110
Okay, 110
531.
531. Okay. We can also look at another combination. Which other combination can we look at? We want to utilize
Yes,
800.
projects 1 and 2.
Okay. We can also look at project 1 and 2. Okay. Indivisible means that you can undertake part of the project. Either you undertake or you ignore. Okay. So we can look at a combination of what? Project 1 and 2. Okay. So let's look at project 1 and 2. What will be the NPV? The total NPV, 57584 plus 32740. What is the total NPV?
90324.
90324. You can see that project 3 and 2 cannot be undertaken. It is impossible because the total cost is more than what? The amount that we have. It is 400 against what? 450. That will give us 850. But we have only what? 800,000. We can undertake part of the project. So the 2 and 3, that combination is impossible because it's more than the amount that we have. Okay. So which of these projects should we undertake? The best combination will be 1 and 3, isn't it? The best combination will be 1 and 3. You pick the one you pick the combination that will be giving you the highest NPV. That will be giving you the highest what? NPV. Sometimes you can invest the surplus amount. The question will give you they will say that any surplus amount can be invested at they'll give you any surplus amount can be invested or can be used to buy equipment that will give you a cash flow of this. So you find the NPV of that particular cash flow. Or they can say that any surplus amount will be invested at this amount or will be invested at this rate. So you also find the present value of the interest that you'll be receiving there. So they will say that, okay, any surplus amount can be invested in accounts that yield an interest of this amount. So you now find the interest that you'll be getting from that place and find the return that you'll be getting from that particular place and find the present value of it. So the question will tell you that the surplus amount. So if you look at the 1 and 2, so someone can look at the 1 and 2, that will give you a total of 750,000. So the question can say that the 50,000 will be invested somewhere which will earn interest of this. So what is the net present value of the total amount that you'll be receiving there? You find the net present value and now add it to the what? The present value that the two projects will be giving to you. Or if you are using 1 and 3, you see that will be 300,000 against what? 400,000. That will be 700,000. There will be a surplus fund of 100,000. So the question will tell you that the surplus fund can be invested into an investment that will be yielding interest of this amount. So you also find the present value of the cash flows that you'll be receiving over there. Then you add it to the total cash flow from the two projects before you undertake the investments. Okay, but this one, the surplus fund will not be reinvested or will not be invested into any other projects. So we just do that. We make the decision based on these ones. Okay, so this is how we go about it. If it is divisible, we use the profitability index. If it is indivisible, we can only undertake projects that our money can work or that our available funds can afford. So we look at the best combination for the investments. Okay. Please, they are here to examine something like this. Okay, so you have to pay attention. Let's take the other parts. So this is what we call the capital rationing. Capital rationing occurs when the company cannot undertake all the available investment that they have. You can see that all the investments are viable. They are all good investment because they are all giving a positive return. But can we undertake all? No, because the available funds cannot allow us to undertake all the investment. That is what we call the capital rationing. So the capital rationing occurs when the company cannot what, or the available funds cannot permit the company to undertake all the profitable what, investments. They cannot take advantage of all the profitable opportunities because of the what, the limitation being imposed by the what, the funds that they have. The funds is now a hindrance, is now an obstacle to them for undertaking all the investments. So the money that you have cannot allow you to undertake all the what, the best opportunities that are available. So we say that a company is facing what we call capital ration. Okay, let's so explain how the MPV investment appraisal method is applied in situation where capital is rationed. So we can look at what we have done over here. So if the project is divisible, we use the MPV to rank the project. So we can only invest in the project that our money can afford. But we can't just invest in any project, the one that is giving us the best what, MPV, the highest MPV. So we can use the profitability index when capital is rationing, or we can just look at the best combination when capital is rationing. So we use the MPV, we use the best one, we use the highest MPV to advise ourselves which of the project that we should undertake. So that is what we call the capital rationing. Okay, that is how we use the MPV, and that is what we have demonstrated in the what, in the workings now. Discuss the reason why capital rationing may arise. Discuss the reason why capital rationing may arise. Okay, we have two types of capital rationing. We have two types of what? Capital rationing. Okay, we have two types of capital rationing. We have what we call the soft capital rationing, and we have the hard capital rationing. The soft one is an internal issue. It is due to the decision that management is making. It's something that is internal, so mostly it can be handled. So the internal factors are within the control of the company. So the soft one are those internal factors that is making the company not to have available funds or enough funds to undertake the project. The hard one has to do external issues where the bank is what, is refusing to what, to give additional loan to the company. Where the bank is refusing, or government has passed a legislation that you can't invest this amount of money on a project like this. Okay, so the hard one has to do with the external what, factors. Okay, what are some of the reasons that may cause the soft capital rationing? So the capital rationing, you just put the two reasons together. You can state all the internal ones, or you can also state all the external ones. The first one is that management may be what? May be refusing to issue additional share capital. So we are looking at the investments, we see that the investments are good, but management will be refusing, that they don't want to issue additional share capital. So management will refuse to issue additional share capital, something that management can do. Management can have control over that one by now issuing the share capital. So they'll be refusing to issue additional share capital. They can also refuse to issue additional debt capital, or they will refuse to issue shares from what? Or raising investment or raising funds through debt sources. They can refuse to utilize that particular source. Okay. Okay, management can also say that, okay, we don't want to finance the project from any other source. So we want to use our retained earnings. So since we are using the retained earnings, we can only undertake project that our retained earnings can afford. We can only undertake project that the retained earnings can afford. So management can restrict the level of the investment in the project to the what? To the amount of retained earnings that they have. So we don't want to issue any shares, but we want to limit the level of investment to the available retained earnings that we have. So these are some of the some of the reasons why capital may be rationing internally, which is a soft capital rationing. Let's count to the external one. So the external one, I've said that already. Government, there may be a government restriction on what? On bank lending. So government can say that, okay, banks cannot what be able to lend to the borrowers or the users of funds up to this amount. If you want to lend or if you want to give an amount or give a loan out to a company, the limit is what is this amount. So the government will be placing a limit, borrowing limit or bank overdraft limit or loan limit that no bank can be able to what to lend up to this amount of money. So if your investment is more than that particular amount, you can't be getting an amount to that particular one. Okay, but if you have a return earnings, then you can utilize the return earnings together with what? With the bank loaner you'll be taking. So you can combine the two and try to what? To undertake the project. Okay. So sometimes the institutions, the lending institutions may just refuse to what? To give money to the company. They may consider the company to be very risky. Why? The debt structure of the company is now 60 against what? 40. The company is financed to 60% of debt, 40% of equity. So if you are advancing additional loan to this particular company, you might be losing your investment or you might be losing your money. So they will consider the company to be very risky or they are highly jet, and lending institutions may refuse to what? To lend to the company. And that the company will not get the required amount of what? Investment that they need for the required amount of funds that they need for the investment. And that can also be preventing them from taking advantage of all the profitable opportunities available. Sometimes the cost of capital also, the cost of capital may be very high and the company may be what? May be discouraged to raise additional funds to what? Or to fall on the external sources to get the needed funds for the project. So those are some of the reasons. You can put the two and those ones together. Discuss the meaning of the term relevant cash flows in the context of what? Investment appraisal. Give examples to illustrate your discussion. What do you mean by relevant cash flow? Adam, what do you mean by relevant cash flow?
They are cash flows that are directly attributable to the investment we are undertaking.
Okay. Okay.
For example, is
okay.
you are saying something?
Yeah, I'm saying that is not bad.
Okay.
It's not bad. Okay. So example is what? We are now looking for the example. Yeah, then we are still waiting for the example.
Saving labor costs like it was stated here. So yeah.
Okay. So the labor cost, we use future cash flows, which can be labor cost that is going to be incurred maybe in 2 years' time. Okay. So we use the relevant cash flows are those cash flows or those costs that are directly attributable to the investment. We can only incur those costs as a result of the investment, and these costs will be incurred maybe in the future, or they are incremental costs, or they are opportunity costs, or they are what we call differential costs. So incremental fixed costs. If you have a parking space that you are currently paying a rentals of 2,000 for it, you want to buy a new car, your rentals has now increased to 25,000. You can see that the new car has now increased the rent to what? 25,000. The 5,000 increase over there is a relevant cost or a relevant cash flow for the new car that you are buying, because it is because of the new car that you are paying the additional 5,000, and that's what we call the incremental cost. So for fixed costs, we always use the incremental cost, the additional cost that you'll be incurring as a result of the decision. So the company will be having existing fixed costs, whether they undertake the decision or not, that particular cost will be incurred. So you just look at what is the additional cost, what is the incremental cost that you are going to be incurring as a result of the decision or as a result of the investment. That's what we call the incremental cost, and they are also a relevant cash flow. Let's look at sensitivity analysis, what we call sensitivity analysis, and how do we calculate it. Okay. Sensitivity analysis, we are just looking at how the variable items will respond to a change, or how the NPV that we have calculated, how is it going to respond to the change in the variable items? Okay, we are saying that our selling price per unit is going to be 10 cedi for every year. What if there is a change in the selling price? What if the selling price increases by 5%? What will be the effect on the NPV? If the initial cost has increased by, we are estimating our NPV based on the initial investment being 1 million. But what if the initial investment increases by this percentage? How would that affect the NPV? How would the NPV of the project respond to that particular change? That's why we say the sensitivity analysis. So sensitivity analysis answers the question, what if this thing happened? So if the variable cost increases by this amount, what will be the effect of that on the projected NPV? Or how would the NPV respond to that particular increment? That's what we call the sensitivity analysis. So the sensitivity analysis has to do with the uncertainty. Sensitivity has to do with the uncertainty. The probability and the simulation has to do with the risk. For the risk, we know the possibility of the thing being true or being what. So we have possibilities. So maybe there's a 50% chance that this will happen. There's a 50% chance that this will happen. So it is likely that it will be a loss or it will be a gain. It is 50-50 situation. But for the uncertainty, we don't have any control over the situation unless the thing happens. So what if this thing happened? What will be the effects on the NPV, on the projected NPV? That is what we call the sensitivity analysis. How do you calculate sensitivity analysis? Whatever be the case, whether the question asks you to calculate the NPV of the project, you have to calculate the NPV by force, because you can't do the sensitivity calculation without you calculating the NPV, because sensitivity analysis for each of the variable is given as like this. So sensitivity analysis for each of the variables is calculated by the NPV, the projected NPV over the NPV of the variables. So we look at the present value of the variable, not NPV, but the PV of the variables. The PV of the variables. The variables can be revenue, it can be contribution, it can be initial cost, it can be the selling cost, it can be the fixed cost, it can be anything. So if the thing has to do with cost, okay, all the calculation that has to do with cost, variable cost, fixed cost, revenue, all those items that has to do with amounts. This is how we calculate the sensitivity analysis for them. So it will be the NPV calculated from the project divided by the PV of the variables times 100. But if you are doing for useful life, what if the useful life changes? The formula is different. So all these things that will be dealing with amounts, money, this is how we calculate the sensitivity analysis for them. But those has to do with differences, maybe useful life. What we do is that we calculated a discounted payback period because we are using NPV. So we calculate discounted payback period. We compare with the useful life. Okay, so you compare the discount, you calculate the discounted payback period. Then you compare with the useful life. Okay, then you divide by the useful life and multiply by 100. This is if you are doing the sensitivity analysis for the useful life. This is how you do it. You calculate the discounted payback period. Then you subtract the useful life, or any of them that is bigger. Any of them that is bigger, you do the subtraction. Okay. But if you are looking for cost of capital, we want to know how, by what percentage should the useful life increase or decrease for the project to break even or for the project to make a loss. Okay, the cost of capital, we want to know by what percentage should the cost of capital increase by or reduce to for the project to make a loss or for the project to break even. So what we do is that we calculate the internal rate of return minus the actual cost of capital, which is the nominal rate, the one given to you. Then you divide it by the nominal rate, then you multiply by 100. So this will tell you by what percentage that the cost of capital should reduce or should increase for the project to run into a loss or for the project to break even. That's what we do. But for the remaining one that has to do with amounts, it is the NPV over the present value of all the variables multiplied by 100. What do we mean by present value of all the variables? If you are giving revenue for each year, you find the present value of the revenue for each year and put them together, because we assume that the cash flow will be arising at the end of every year. So you find the present value of each of the variables, put them together, and that is what we call the present value of all the variables. So let's pick that question and we look at how we go about it. All right, it is a very simple one, not complicated. And let's look at how we do. So the question is saying that we should calculate the NPV of the project. What is the lifespan of the project? What is the lifespan of the project?
Two years.
2 years. Okay. What is the revenue? The revenue is what? 10,300, and the variable cost is what? 3,200. So you don't have to calculate the cash flow statement, because the question has given you the net cash flows already, which is the revenue minus what? The variable cost. There is no fixed cost in this particular question. Do you have a fixed cost here?
No.
No. If you have a fixed cost, then you take the fixed cost from the net cash flow. Then that will give you, because the net cash flow over here is just the revenue minus what? The variable cost. Okay, then you just look for your contribution. This will give you the contribution. Then you take the fixed cost from it. Then you now have your net cash flow. They can also give you, the question can also give you tax elements. So you can also have, they can give you a tax element. They can also give you capital allowance. They can also give you residual value, working capital management. It means that you have to do the calculation and get your NPV. You have to do the calculation and get your NPV and use it. But since the focus is not for how you can calculate the cash flow, the focus is for how you can estimate the sensitivity of all the issues. They will not bother you with those complex issues. Okay, they will not bother you with those complex issues. So this one, we can calculate the NPV of this particular project straightforward. How do we do that? We know our initial investments. So we look at the years over here. We look at the cash flow. We look at the discount factor. Then we have the PV. We know that our discount factor is 9%. Okay, so let's count to year 0. What is the cash outflow? It's 11,000. Okay, so we have 11,000 as an outflow, 1.00. Okay, so this will still be 11,000. Okay, let's count to year 1 to 2. You can see that the cash flow is constant, it's annuity. Okay, so that the net cash flow over there is 7,100, which is an annuity. So let's find annuity for 2 years at 9%. What are you getting?
1.759.
Okay, so what will be the net present value?
One, 2, 4, 8, 9.
1, 2.
4, 8, 9.
Okay, so what will be the NPV now?
$1,489.
Okay, 1,489. Okay, so that is the present value. Okay, the focus is not about how to calculate present value. Okay, the focus is how to do the sensitivity analysis for each of them. So measure the sensitivity analysis, measure the sensitivity of the project to changes in the following variables. So the first one is what? Initial investments. So let's look at the initial investments. So we have The first one is initial investment. Let's have the initial investment. So initial investment, it will be NPV calculated over the PV of the variables. Which variables is the initial investment multiplied by 100? Okay. So the NPV is 1489. Okay. Divided by the initial investment, the present value of initial investment is still the same as the 11,000 multiplied by 100. Okay. So what are you having in terms of percentage?
%13.54%.
Okay. 13.54%. Okay. 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 They can ask you to comment on the answer. The interpretation is that if the initial investment should increase by 13.4 or should increase more than 13.4, the project will run into a loss. The project will run into a loss. So if the initial investment increased by 13.54, okay, the project will break even. But if it should be above 13.4, the project will run into a loss. Okay, so sometimes they can ask you to comment on the answer. Okay, so if the initial investment increases by 13.54, the project, or increases exactly by 13.54, the project will break even. That means that the NPV will be 0. But if it should increase above 13.4, the project will what? Will run into a loss. That is the first one. Let's go to the second one. What is the second issue? Sales what? Okay. The sales volume is always the contribution. Okay. Sales volume is always the contribution. So we look at the present value of the contribution. So we'll be having 1489 divided by, we look at the present value of the contribution now. What is the contribution here? So on this question, what is the contribution?
$7,100.
Okay, so you discount it for each of the years. So 7,000. The contribution is just the revenue minus the variable cost. So that is the sales volume. So you do it for each year, each of the years, and present value it, because we are talking about present value of the variables. So year 1 is 7,100. You present value it using the discount factor. Year 2 is this one, you present value it. So after present value, then you put the two together. But we have done that one already. So we can just go and pick the answer there. You can see that we have present value this particular one already, isn't it? So we are having 12,489. Do we agree to that? Multiplied by 100. What are we having? $11.92. Okay. Please, this, if you are doing an interpretation for cost, it should be increased. But if you are doing for revenue, it should be a reduction. So it means that if the contribution should reduce by 11.92, the project will break even. But if the contribution should reduce more than 11.92, the project will run into a loss. So if you are doing a cost, the percentage will be an increase. But if you are doing it for a revenue or a revenue item, the interpretation will be a reduction. Okay, so if the contribution, the current contribution should reduce by 11.92, the project will break even. But if it should be above 11.92, the reduction should be above 11.92. Then the project will run into a loss. Let's go to the second one, the third one rather.
Linus, please, a question. Yeah, initially, when I was going through with the sales volume, I thought of using the cash flow arises from selling the unit.
See, I can't hear you. Your voice is
Giving that part of the question. The volume at which the revenue. Hello.
Yeah. Can
yes,
you,
please. I'm saying that.
Oh. You're off
Please,
again.
can you hear me?
Yes, I can hear you now.
Yes, I was saying that when I looked at the question initially about for the sales volume, sensitivity for the sales volume. Yeah, initially I was thinking that we will use the units given for the selling price. I mean, sorry, the revenue.
Okay.
That was what I was thinking.
The revenue is the selling price.
Yes, please. I
Okay.
mean, the units given
Multiplied by
because
the
it's talking about
multiplied by the selling price.
yes, please.
Then
As in the 10.
that will give you 10,300.
Oh yes, for that volume. So I was thinking that we'll use that unit
No,
rather.
we don't, for the volume, we don't use the units. Even if you are using that, then if you are using that particular one, that is the selling price. Okay. So for volume, we use the contribution. We don't use the unit given to us. Okay. We use we don't use the units. Okay. So you don't use the units.
All right, sure. Thank you. Okay.
Okay.
Thank you.
Okay. So what the volume, what we do is that we do it on the net effect. So if the unit is increasing, the variable cost will also be increasing in that proportion. Selling price will also be increasing in that proportion. So we use the contribution, like how if you are calculating the sales volume, you use the budgeted contribution or something. So we do the contribution also over here for the volume. All right. So let's come to the selling price. Okay. Let's come to the selling price. The selling price will be the revenue. Okay. The selling price will be the revenue. So 1489 divided by the present value of the revenue. So you can find the present value of the revenue as, okay, 1.759. That is the annuity multiplied by 10,300. What are we having?
$18,118.
Okay. Multiplied by 100. What are we having? So 14.
8.23.
8 point what?
23. 8.22, sorry.
Okay. What is the interpretation over here?
If the selling price will reduce by 8.22, this will break even.
Okay. But if it should be above, what will happen?
They will make a loss.
Okay. So let's come to variable cost. Okay. So they can also give you fixed cost. You just find the present value of the fixed cost. So let's come to the variable cost. The variable cost, we know that our present value is 1489 divided by the variable cost. The variable cost over there is 3,200, isn't it? So we can have 3,200 multiplied by the annuity because we are finding the present value. So all of this multiplied by 100. Yes, yeah. Okay, well, what are we having?
I don't know if it's correct, but I'm getting to 26.45.
Okay, I'm coming. Let me check.
It's correct. 26.45. Why do you say you don't know if it's correct?
Because you see, it has jumped too much, so I'm looking at the other ones.
Okay. What will be the interpretation?
If the variable cost will increase by this amount, the project will be zero.
The NPV of the project will be 0. Okay.
Sorry, the NPV,
But-
yeah.
But if it should be above this one, what will happen?
It will make a loss.
Okay. They can also give you a fixed cost. So the fixed cost will be annual fixed cost. So you present value the fixed cost over the project life and bring the present value here. Okay. Right now they are giving us cost of capital, isn't it? Okay.
Yes.
Cost of capital, what do? We say that for the cost of capital, the sensitivity is calculated as what? The internal rate of return minus the actual cost of capital divided by the actual cost of capital multiplied by 100. So what we have to do is that we have to calculate the internal rate of return. You can see that we have 9% already. That is giving us what? 1489. So what do? We just increase this particular rate to, let's say, 12% or maybe 13 or 15% and get the negative NPV. So we look at, let's calculate that this one under this one and look at the negative NPV over here. Okay. So we have the years over here. The 0 will still be 11,000. Let's count to year 1 to year 2. Let's use 15%. The cash flow will still be 1,700. So let's look at what we are getting there. 15%, annuity for 15% for 2 years. What are you getting?
$1.626.
1.626.
Six.
Okay. If you multiply by the 7,100, what are you getting? 1.626 multiplied by 7,100. It's still giving us positive, isn't it? You'll still be getting positive.
Yeah.
It's positive.
Yeah.
So what we do is
Yeah,
that,
that's true.
what do we do?
Let's increase it further to 20%.
Okay.
Maybe 20.
So let's make it 20 now. That's why I said that you should pick a reasonable rate. If you don't pick it, you'll still be getting positive. So let's make it 20 and see, 20% and see.
Okay. So the annuity for 2 years would be 1.528.
Yes.
Sometimes you are picking the rate, you can be trying it on the calculator to see whether it will give you positive or it will give you negative. But this one is giving us positive because of the duration. Okay. Because it's only 2 years, that is why. Okay, this is now giving us negative, isn't it?
Yes.
Okay, negative of 151. Okay, so we can then use the internal rate of return formula to have the lowest rate of 9% plus 1489 divided by 1489 plus 151 times 20% minus the 9%. Okay, so we can say we have the 9% plus 1489 over 1640 times 11%. Okay, let me show you the formula sheet, and you see the internal rate of return formula. Okay. Okay, so this is This is the internal rate of return formula, which is what we use for the debts, the redeemable debts. But let me show you the formula itself. Okay. So you can see the internal rate of return. This is the formula, the first one. That is the formula for internal rate of return. The one that we have used first, the Fisher's equation. The one that I've used to calculate that one is the Fisher's one over here. Okay. So that is, they will provide you with the necessary formulas in the exam. Okay. So what are we getting for the internal rate of return?
Can just make it 19.
Okay. So 1640 times 11.
18.99%.
Okay. So can we make it, okay, 18.99%. So that will give you 18.99% minus the 9% divided by 9 multiplied by 100. Okay. Minus 9 multiplied by times 100. You can see that the rate has to increase by what? 110 what? Or 101%. You can see that the increment is over 100, isn't it? Okay.
So 100.
Okay. So it is 101. So if the cost of capital, the current cost of capital increases by 110%, the project will break even. If it is increases by 110%, then that will now give us the internal rate of return. So if the cost of capital increases by that particular percentage, the project will break even. But above that, the project will run into a loss. That is all about it. Let's look at what we call lease or buy. Let's pick a question on lease or buy. A situation where the company wants to undertake a project, but they are thinking whether they should buy the assets themselves or they should lease it from what? From a different company. Whatever be the case, you have to know that if the company is buying the asset themselves, the tax authority will be giving them capital allowance and any expense, most especially maintenance cost. Okay, any expense that the company will be incurring under the acquisition, it will be allowable for tax purposes. So the company will be buying the asset, they will be enjoying the tax benefit on it. And if they are going to do a maintenance, the tax authority will allow them to subtract the maintenance from their profit before they charge tax. So there will be a tax benefit on the maintenance cost too. The company will also be, you can see that the question will be saying that the company will be paying tax emission fees, like the one that you people you have introduced right now, those emission fees or something, the vehicle emission fees. Okay, the company will pay it and it will also be allowable for tax purposes. So what we do is that we look at the purchase option. If the company is purchasing, what are the costs that they are going to be incurring? And what is the benefit that they are also going to be incurring? We net the two, then we present value it to know their list, their cost, the net present value of the cost that they will be incurring. Then we go to the lease option. The company might be using operating lease or finance lease, but in the exam, it will always be an operating lease. If it is a finance lease, you have to calculate the right of use. If it is a finance lease, you have to calculate the right of use to do the depreciation. So if it is a finance lease, the company will be joining capital allowance on the what? On the depreciation every year. So you have to calculate the right of use and calculate the depreciation. But whatever be the case, the interest plus the capital payment will also be tax allowable. So the company will be enjoying tax benefit on the what? On the rent tax. But the question will always give you the operating lease because you are not it's financial management, not financial reporting. So you don't have to be using IFRS 16 to do that, no. So the question will always give you operating lease. If it is an operating lease, the lease rent tax, if you pay, it will be tax allowable. So you'll be enjoying some tax benefit on it. But you have to take into consideration how the rent tax is being paid. It can be paid in arrears or it can be paid in advance. Okay, what rate do we use what discount factor do we use? We assume that the company does not have money available and they are going to borrow. They are going to take loan to finance the what? The purchase. So what we do is that we use what? After tax borrowing rate. The question will give you the borrowing rate. If nothing is being said about it, you assume that is before. So you find the after tax. You find the after tax. So let's pick the question 5 and look at how we go about that particular situation. Okay. Let's see whether we can finish this before 9 p.m. so that we use 1 hour 30 minutes for the working capital. All right, Adam, we are in your hands.
Okay, question 5. AGD company is a profitable company which is considering the purchase of a machine costing 320,000 Ghana cedis. If purchased, AGD Co would incur annual maintenance cost of 25,000 Ghana cedis. The machine will be used for 3 years, and at the end of this period, will be sold for 50,000 Ghana cedis. Alternatively, the machine could be obtained under an operating lease for an annual lease rental of 120,000 Ghana cedis per year, payable in advance. AGD Co can claim capital allowance on a 25% reducing balance basis. The company pays tax on profits at an annual rate of 30%, and all tax liabilities are paid 1 year in arrears. AGD company has an accounting year that ends on 31st December. If the machine is purchased, payments will be made in January of the first year of operation. If leased, annual lease rentals will be paid in January of each year of operation. Required: A, using an after-tax borrowing rate of 7%, evaluate whether AGD Co should purchase or lease the new machine. B, explain and discuss the key differences between an operating lease and a finance lease. And then C, the after-tax borrowing rate of 7% was used in the evaluation because a bank had offered to lend AGD company 320,000 Ghana cedi for a period of 5 years at a before tax rate of 10% per year, with interest payable every 6 months. Required: I, calculate the annual percentage rate implied by the bank's offer to lend at 10% per year with interest payable every 6 months. I, calculate the amount to be repaid at the end of each 6-month period if the offered loan is to be repaid in equal installments. Yeah, okay, done.
You consider the C part is time value of money.
Yeah.
Okay. So you can see that this has to do with what? How to calculate for loan, isn't it? Okay.
Amortization.
Okay. So how to calculate? You use the present value of the ordinary annuity to calculate the amounts that a company will be paying every year. Okay. But what they are asking you over here is the effective interest rate. The first one, calculate the annual percentage rate implied by the bank offer to lend at 10%. So that is the effective interest rate. So you see that if the bank is lending, they will charge interest for 6 months, and that particular interest will still attract interest. Okay, so that they are asking you for the effective interest rate. Okay. Okay. So that is that. But I will not touch that side. Now focus is on the lease or buy. Okay. So let's now come. They are saying that you can see that they have given you the after tax borrowing rate already, isn't it? So let's look at if the company want to purchase, what will be the option? If they want to lease, what will be the option? So let's look at the purchase option. Let's look at the purchase option. So what we do is that we have the years. We have the years. You have so many ways of doing this. You have so many ways of doing this. You can decide to calculate the net cost yourself and present value in a tabular form, or you can just do it like the way we do 0, 1, 2. How many years? The machine will be
3
used
years.
3 years. Okay. Okay, so that will be 3 years. Okay. So what we do is, let me just make this one so that it will be okay. Years will be, so we have 1, 2, 3. Okay. So let's come to the initial investments. Please, sometimes the question can also tell you that the initial investment will be paid at the end of the year, at the end of the first year. So it means the initial investment will not be year 0. It will be under year 1. So you have to discount it. Okay, sometimes the question can tell you that all cash flows, including the initial investment, will be arising at the end of the first year. So initial investment cannot be under 0 again because it will be paid at the end of the year. So you have to discount it. Okay. So let's count to how much is the company buying the assets? 320,000.
320.
Okay. So 320,000. So that will be an outflow. Okay, then we have dash, dash, dash. What is another cost that they will be incurring?
Maintenance cost.
So maintenance cost will be incurred at the end of the what? The first year. Okay. For 3 years at the end of this period will be. Okay, so the maintenance cost, if nothing is being said, it will arise at the end of every year. So what will happen over there? That will be an outflow also, 25,000, 25,000, 25,000. Okay, what else? Okay, there can be some other costs like the one that I've said, that the emission fee or something like that, for the this thing that you are causing, the pollution that you are causing in the environment. Okay. So the machine will be used for 3 years. At the end of this period, will be sold for what? 50,000. Okay. Alternatively, the machine could be obtained under the lease. Okay. AGD Co can claim capital allowance on 25% reducing balance basis. The company pays tax on profit at an annual rate of 30%, and all taxes are paid 1 year in arrears. So I have to add year 4 to this one. Hey, so I have to add year 4. How do I do that now? Okay. I have to add year 4. So what I will do is I have to make this one to be investments. So the investment has to be 32,000. 20,000. So year 1 dash, year 2 dash, year 3 dash, year 4 dash. So this will be 25,000. 25,000. 25,000 and dash. So if we come to what we do now is we have the scrap value, the residual value. Okay, the residual value is how much?
50,000.
At the end of year 3, isn't it?
Yes.
Okay, that will be inflow. So we put that here, we put that here. The next thing that you have to do is to do the calculation for your tax benefits. Okay, so let's go to the tax benefits. Please, I said that any other cost incurred will be tax deductible. So what will happen is that the maintenance cost for every year will be tax deductible. So you calculate the tax benefit on the maintenance cost. So 0.3 times 25,000. So every year the company will be enjoying 7,500 tax benefits. Let's count to this one. This will be years, the cost, the depreciation, and then the tax benefits. So let's count to year one. What is the cost at the start of the year? 320,000. Okay, 320,000. What will be the depreciation on it? 25%.
Yeah.
Okay, so what is the depreciation on that? 0.25 times 320,000. I'm having 80,000. Okay, what will be the tax benefit on it? Would that be 24,000?
24,000.
Okay, what will be the carrying value for year two? $240,000. Is that correct?
240, yes.
Depreciation is 60,000. Are we confirming that? Year three, what will be the carrying value?
$180.
Okay, this
180.
180, what will happen? The machine will be sold at the end of the year, isn't it?
Yes.
So what will be the net amount that the company will be enjoying the tax benefit on? That will be 180,000 minus the
130.
okay. So they will be enjoying. So they will allow the capital allowance on the full amount. So you just apply the 30% on the 130, 0.3 times 130. So I'm having 39,000. Is that correct?
Yes, please.
Okay. Let's count to the tax benefits, the total tax benefits. The total tax benefit will be the what? Year one. What will be the total tax benefit for year one? You see that the capital allowance will come, and the tax benefit of the
Right.
maintenance will also come. Yes, please.
Please, the residual value is it 50,000 or 5,000?
50.
Let me check. It's
It's
50,000.
50,000.
Yeah.
Oh, okay, all right.
Okay. So what will be the total tax benefits? We are going to be having capital allowance for the first year 24,000, and maintenance we are having 7,500. Year two will be 18,000 plus 7,500. Year three will be 39,000 plus 7,500. So the 24,000 and this one, they are only relating to the assets, the capital allowance that you are enjoying on the assets. But the maintenance cost will also be tax deductible. So what is the tax benefit that you are getting on that one also? So we add them one by one. 7,500 plus 39,000. That will give us 46,500. This will give us 31,500. And we have 18,000 plus 7,500. We're having 25,500. I hope we are okay with that. Okay,
Yeah, we are.
let's count to tax
Please,
benefit.
the 7,500, where do we get this from?
Is the capital allowance on the maintenance cost.
Okay.
Okay, so if you pay the maintenance cost of 25,000, the tax authority will allow you to subtract it from your profits. So there's a tax benefit of certain amount on it. Okay, so it means that you are not indirectly you are not paying all the 25,000 because that 25,000 is giving you a tax benefit of what 30%. So indirectly you are paying 70% of the cost, and the tax authority is paying the 30% because if not for the maintenance cost, you'll be paying 30% on the profit that you are subtracting the maintenance cost from. So that is the assumption around it. But the tax is paid. How do we pay the tax? 1 year in arrears, isn't it? Okay, so the tax benefit for the first year will come in year 2. So 31,500, which is inflow, will come in this one. 25,500 will be enjoyed in year 3, and year 3 will be enjoyed in year 4. 46,500. Okay, so what we do is we determine our cash flow, then we now discount it. So we have the 320,000 here. Then we have a negative of 25,000 here. What will be the difference between these two? Would that be 6,500?
Yes, please.
Okay. Would this be 50,500? And would this be 46,500? Okay.
That's right.
We now look at the discount factor, which is 7%. So let's get a discount factor. This will be year 0, which is 1.00. Okay.
Hello, Lance.
Listener.
Yeah, please,
Yeah.
can you go to the tax benefits schedule for me? The second one. The 24,000. The year 1, another the second tax benefit.
Okay. Year
The
1 is capital
24,000.
allowance.
Is it the tax benefit from the first schedule?
The capital allowance. That is for capital allowance.
Okay.
So please, can we get the discount factor one by one so that we move on? The discount factor is 7%. We use after tax cash flow. So as you are getting that, let me be doing the leases one. So the lease. So we have the years. Then we have 0, 1, 2, 3, 4. So we have the rental payments. Okay. How are we paying the rentals? Is it in arrears or in advance?
Advance.
Okay. So it means that the first one will be paid now, which is year 0, isn't it? Okay.
Yes.
So we have 120,000. We have 120,000. We have 120,000. So year 3 and 4 will be dashed. This will be for only 3 years, but we are paying now. So this is how it will be. Let's count to the tax benefits on the. So sometimes the question can tell you that under the 2 options, the maintenance cost will still be incurred. So even if you are leasing, you will still be incurring the maintenance cost. So we add the maintenance cost as an outflow, then we bring the tax benefit on the what? On the maintenance cost also. But what we do is that the rental payments will be allowable for tax. So what is the tax benefit that you are enjoying on the rentals every year? 0.3 times 120,000. I'm getting 36,000. And this will start from year 2 because the tax is paid 1 year in arrears. So the first year's own tax will be enjoyed in the what? Okay. So okay, tax is payable in arrears. So we have 36,000 here. 36,000 here. Okay. So this will be, we have an outflow of 120,000. Outflow of 120,000. Okay, this will be 36,000. What is the difference? Year 2. $84,000. 36. This will be an outflow of 36,000. 36,000. So you use your discount factor 7% to discount them. Then you total the cost. This it will be a net cost. So you total the cost and see which of them is giving you the least cost. This is a cost. So which of them is giving a least cost? The one that is giving you a least cost, then that is the option that you'll be picking. Okay.
Brain,
Yes, please.
you were saying something about the discount factor. Is it you say after tax or whatever?
And we use after tax cost of debt or after tax borrowing rate. So the question will give you, if they give you pre-tax, your after tax will be the tax rate or the cost. So you look at your rate into bracket 1 minus t. That's how you find it.
Like the 7% that is given, we'll still do 1 minus t
No,
for
no.
it.
That is after tax already. Assuming you are giving the 10%. The 10% is before. So you just do 1 minus 0.3. That's how you
Okay,
avoid
that's
the.
all right. That is what I want to understand.
Okay.
Linus,
Yes, please.
with the leasing, are we going to add the cost saving of the maintenance?
No. We are not doing any maintenance under the leasing.
I thought it would be a cost saving to us because we are not incurring repair costs, maintenance costs. Oh,
No,
This
we
one
don't.
is
We only look at the options one by one. If you are not buying, these are the decisions that you are going to be undertaking. It's not that you have purchased the machine already and you want to start leasing it. If you are already incurring the maintenance cost of the machine and you want to start leasing it, then it means that the maintenance cost will not be incurred again. But this one, you are here to incur the maintenance cost. It's not a cost that you are currently incurring. So if you want to buy, that is why you'll be incurring the maintenance cost. If you don't want to buy, what is the cost that you are going to be incurring under the lease? So it's not that the company is currently incurring the maintenance cost that if you want to lease, then there will be a cost savings to you. No.
okay.
All right. Okay. Let's look at this one. Look at how I have done the tax benefits. Okay. So the tax benefits are supposed not to come like this. Okay. So it means that if we pay right now, we are going to be enjoying tax benefits right now, isn't it? So it's supposed to start from 36,000 year one. Okay. If the rentals is in arrears, that is why it will come like that. So this will also be 36,000. So we are not going to have any year four for this one. So this will be 84,000. All right. So if you pay right now, you are going to be having a tax benefit on it right now, but this will be given to you in a year time. So that will be at the end of year one. Okay. So sorry for that part. There will not be any year. You can only do that if the tax is paid, if the lease is in arrears. If it is in arrears, then it means that the first payment will start from year one. So your tax benefit will go to year two. Okay. So that is it. So let's look at the discount factor. You discount it, then you bring, if you add, you'll be getting a cost. So you ask yourself, what is the cost under the purchase option? Okay. What is the cost under the purchase option? What is the cost under the lease option? Which of them is lower? Because this is a cost. This will be a cost. So which of them is lower? You pick that particular one. Okay. Let's move on to explain and discuss the key differences between an operating lease and a finance lease. What are the differences? Finance lease and operating lease. What is the difference? Please, what is the difference between finance lease and operating lease? Please, can you hear me? Okay, let's look
We are
at,
calculating the cost though.
you are still calculating the cost. Okay. The difference is just like the what we know in financial reporting. Okay. So let's calculate, let's count to asset replacement decision. Asset replacement decision. Okay. So the question 7 is about NPV and also so I will not bother myself about the project 1. I will just count to project 2, which is about asset replacement decision. So a company will purchase an asset and they want to know when they should replace the asset. When they should replace the asset. So should we replace the asset every 2 years? Or should we replace the asset every 4 years? How do we go about it? So we call it asset replacement decisions. We have 2 methods of recommending to the company how they should replace the assets. We have the annualized method, and we also have the least common multiples method. But it's the annualized method that is common, and that is what we are coming to look at. Okay. So these are the 2 machines that we have over here. Sometimes the question will give you the initial cost. We also use the NPV for this one. So the question will give you the initial cost and also the running cost. So the question will give you maybe some trading values. Okay, this one, the question has not given us some residual value. Okay, so the question will give you, they will give you the initial investment. Okay, they will give you the initial investment, maybe 10,000. Then they will give you the running cost for the first year, maybe 5,000. Then they will give you maybe residual value for the first year. They can give you residual value for the first year. Okay, they can give you residual value for the first year to be 3,000. Okay, you can only get a residual value for each year if you decide to sell the asset for that particular year. So if you are selling the asset for the first year, you'll be incurring a initial cost of 100,000. Then first year running cost of what? 5,000. Then if you are selling the asset, if you decide to replace the asset in year 1, that means that you'll be selling it at the end of year 1. Then you have 3,000. So it means that the net cost that you are spending over here is 2,000. So you are having a running cost of 5,000. And you'll be having a residual value of 3,000. So you are incurring a net cost of 2,000. Sometimes the question can give you the running cost for the first year, the running cost for the second year, and they will give you the residual value for what? For the second year. You can only get the residual value if you are selling the asset at the end of that year. So you are not selling the asset, or you're not replacing the asset at the end of the first year. So there is no way first year's residual value will be claimed in second year, no. So you still have the running cost of the first year, which is 5,000, because you will pay the asset for 2 years before you sell it. So you have the running cost for the first year, running cost for the second year, but you are going to be having a residual value for the second year. I have solved a question like this in the other issues on investment appraiser, and I have that particular video on my YouTube channel. But unfortunately, I don't have that question here. They can give you a question like that. They will give you the residual value for each year, and they will ask you, the company should choose between the time that they should replace the assets. You have to be doing it one by one. You do the first year. If they want to replace first year, what will be the cost? If they want to replace in second year, what will be the cost? If they want to replace in the third year, what will be the cost? Then you will now advise them the year that they should replace the assets. So I've done that, but that is not the question that we have over here. This one, we have 2 assets, and we are going to be telling the company which of them they should buy and why. Okay, or how they should go about it. So let them take the project 2 for us under this particular one. Adam, are you there?
Yes, I'm here.
Okay. Take the two first. Or you are trying to get something before we move on.
No.
Okay.
Is it the question 7, eh?
Yes, the question 7, project 2.
Project 2, okay. Regard company plans to replace an existing machine and must choose between two machines. Machine 1 has an initial cost of $200,000 and will have a scrap value of $25,000. After 4 years, machine 2 has an initial cost of $225,000 and will have a scrap value of $50,000 after 3 years. Annual maintenance costs of the two machines are as follows. Year 1 to 4, then the machine 1 and 2, the amounts are there. So, where relevant, all information relating to Project 2 has already been adjusted to include expected future inflation. Taxation and capital allowances must be ignored in relation to Machine 1 and Machine 2. Other information. Regard Co has a nominal before tax weighted average cost of capital of 12% and a nominal after tax weighted average cost of capital of 7%. Required. A. Calculate the net present value of the Project 1 and advise management of Regard Co. B.
No. Okay.
Calculate the equivalent annual cost of Machine 1 and 2 and discuss which machine should be purchased.
Okay. The question 1 there is just about NPV. It's just about normal NPV, which we can do. That's why I don't want to waste time on that one. Okay. Let's come here. The question says that you should ignore taxation and what? The question says that you should ignore what?
Capital allowance and taxation.
Capital allowance.
Okay. Since the question says you should ignore taxation and capital allowance, we use before tax cost of capital. But if they say taxation, that is what we do the after tax cost of capital. So whenever they say taxation and those things should be ignored, you use the what? The before tax cost of capital. And they say that the relevant cash flow has been adjusted to include future inflation and those things already. So we don't do anything. How do we calculate the annual cost of what? The equivalent annual cost of the machine and those ones? First of all, you have to calculate the NPV. Okay, first of all, you have to calculate the NPV because the equivalent annual cost is calculated as the NPV of the project divided by the what? The discount factor, which will be the annuity. We always use the annuity. So if you are replacing the machine every 3 years, what is the annuity for the 3 years? So divided by the annuity factor. That is how we calculate it. So divided by the annuity factor or the present value. Okay, that's how we do it. So before you can calculate the equivalent annual cost, you first of all have to know the present value of the machine. The present value will always be cost. So we look at the years. Let's take the machine 1. Machine 1, we look at the years. We look at the cash flow. We look at the discount factor. Then we look at the present value. So year 0, what is the initial investment for? What is the initial investment for?
$200,000.
Okay, so we have 200,000. Okay, so we have 200,000. So that will be 200,000. And the discount factor will be 12%. Are you okay? Okay, that will be 1.00. Taxation and those ones should be ignored. So we use that before. If they say taxation should be applicable, then you use the after tax. Okay, so we have year 1. What is the maintenance cost?
$25,000. No.
Now, machine 1 is 25.
Yeah, 1 is 25,000. Yeah, 25,000.
Okay, that will be an outflow, isn't it?
Yeah.
Year 2 is what?
29.
Okay. Year 3 is what?
32,000.
Okay. Year 4 is what?
35,000.
But year 4, what will happen? At the end of year 4, what will happen?
You are selling the asset.
For how much?
25,000.
So what will be the net cost there?
10,000.
10,000. So you bring only the 10,000, which is the net of the residual value and the cost. So you present value these ones and now get the so let's come to machine 2. Machine 2 is what? You have year 0. How much are we buying it?
225,000.
Okay. So let me put the years here. The cash flow, the discount factor, which will be 12%. Then we have the present value. So year 0 will be 225,000, isn't it? Okay.
Correct.
1.00, 225,000. Okay. Year 1, what is the maintenance cost?
15,000.
15,000. Okay. Year 2 is what?
20,000.
Okay. Year 3, what will happen?
We'll sell the machine for 50,000.
Okay. So what is the maintenance cost for that? What is the maintenance?
25,000.
So we are going to be having a net cash flow of what?
25,000.
Okay. So let's get a discount factor one by one and present value them. So at the end of the last year, you just net the residual value against the cost that you are incurring. Okay. Or someone can decide to present value all of them differently. The answer that you'll be getting if you present value the net figure will be the same as if you do them one by one and subtract. Please, can we get the NPV fast? The discount factor for each of the years. So 1 divided by 1.12. I'm getting 0.893.
Yeah.
Okay. Second year is what?
0.797.
0.797. 0.797. Third year is what?
0.7.
0.12.
0.712. 0.712. The fourth year is what?
0.636.
636. So can we now find the this thing one by one? 10,000. So I'm having 6360 as negative 0.712 times 32,000. 22784.
Yeah, 131,255.
Are you sure? It's 25,000 times 0.893.
22325.
325. Hey, Sina Sharif, don't be setting your own question. No. That is the second time that you mentioned the wrong answer. So you come out and say, oh, how was the paper? Oh, it was cool. But what you have written over there, you answered your own questions.
Year 2.
Yeah.
Okay.
Year 2, 23113.
Okay. 23113. So let's put all of them together and have the total cost of the NPV. So I'm having 274,582. Is that correct?
That's correct.
Okay, let's count to 15,000 times 0.893. I'm having 13395. Please, these are all outflows, so you put them in brackets. They are not inflows, they are cost. Okay, so we have 20,000 times 0.797. I'm having 15940. 25,000 times 0.712.
17,800.
This is inflow. Okay, so
Yes.
22. So you now put them together to have 5,000 plus 13395 plus 15940 minus 17,800. So I'm having 236535. Okay. So the question now is they're asking us to find the annualized cost. So the equivalent annualized cost for machine 1 for the machine 1 will be calculated as the present value over here, which is 274582 divided by the annuity factor. This is for 4 years, so you divide it by the annuity factor. So you put all of this together. So you put all of them together. So what is the annuity factor for? 12%, 4 years. So someone can just do it on the calculator and give us the answer.
I'm getting 3.037.
Is it, Adam?
3.037.
037. So what if you divide, what are you getting?
Getting
90412.
Okay, let's go to the second. Let's do it for the machine 2. Okay, machine 2 give us the present value is 236535. 6535. Okay, divided by the annuity. Just put the 3 together. So you divide by the annuity factor for 3 years. So 0.893 plus 0.797 plus 0.712. I'm getting 2.402. So 236535 divided by 2.402. I'm having 98474. Okay. So these machines, which of them are you going to be replacing? You have to know that these are cost. These are all what? Cost. So which of them should you buy based on the annualized cost method? Which of these machines should you buy?
Machine 1.
Okay. Because the machine 1 will cost you less to replace than what? The machine 2. But if the question should ask you that based on MPV analysis, like normal MPV, which of these machines should you buy?
2.
Machine 2.
Machine 2, because the cost that you are going to be getting from it is lower than this one. But if you are based on the replacement decision, machine 1 to be purchased. But if you are basing it on MPV, cash flows, then it should be machine 2. Okay. So that is
Ren,
all
please,
about.
are we buying the machine or we are replacing them?
No, you are here to buy this particular machine. So they say that this one was to replace an existing machine and must choose between 2 machines. Machine A has an initial cost. So you want to replace an existing machine. So you are using this decision to know which of the machines you buy or not.
Oh, okay. All right.
Okay. Okay, calculate the annual cost of this and discuss which machine should be purchased. So we purchase the machine A because the cost of us replacing it is lower than that particular one. So that is all about the investment appraiser. We look at working capital management. We'll be looking at inventory management, which is very important. They have examined it for only once. So we look at inventory management. Receivables management was last sitting. They can still repeat it. But we look at cash management, payables management, there is nothing there. So we look at cash management. If we have time, we look at cash budget. We look at what we call the Miller or and then the BIMO model and the even the receivables. I don't think we should look at the receivables again. But whatever be the case, we have done that in class. So our focus will be on the cash management and also the inventory management. Okay. So if you have time, we look at over trading, issues of over trading. Okay. So let's see. Let's start with the first one, inventory management. For the inventory management, the things that will be asking you, the company wants to reduce the cost of the inventory. Cost of inventory is including the purchase price, the ordering cost, and also the holding cost. So the company might be using the existing what? Order size. So they want to know the optimal order size. So you have to do your economic order quantity. You have to calculate it. So they will be saying that the company is now, this is the plan that the company is having, and they want to switch to economic order quantity. You ask yourself, the existing plan, what is the total cost of the existing plan in terms of inventory? If you are using the economic order quantity now, what will be the total price? You compare the two and see whether they should go with the economic order quantity or they should stick to the existing plan. There will also be an issue of what? Discounts. Supplier will want the company to pay on time, so they are going to be issuing a discounts. So the question will ask whether the company should go for the discount or not. So we take a question like that and we look at it. And that is the first question about inventory management. Let's take the first one.
Please let someone read. I'm a little bit occupied.
Auntie Agnes, I hope you are home now. Read for us.
Okay, please. Dastico wishes to improve its working capital management as part of an overall cost-cutting strategy to increase profitability. Two areas the company has been considering are working capital funding strategy and inventory management. Dastico currently follows a policy of financing working capital needs as much as possible from long-term sources of finance, such as equity. The company has been considering its inventory management and has been looking specifically at component K. Current position. Dastico produces 750,000 units of product M annually. The production of 1 unit of product M requires 2 units of component K. Component K is consumed at a constant rate. The purchase price of component K is $14 per unit. The company places 12 orders each year. Inventory of component K in the financial statement of Dastico is equal to average inventory of component K. The holding cost of component K, excluding finance cost, is $0.21 per unit per year. The ordering cost of component K is $252 per order. Economic order quantity. Dastico wishes to investigate whether basing ordering cost of component K on the economic order quantity will reduce costs. Bulk order discounts.
Okay, I will go top small for you.
Yes, please.
Okay.
The supplier of component K has offered Dastico a discount of 0.5% on the purchase price of component K, provided the company orders 250 units per order. Other information. Dastico has no cash but has access to short-term finance via an overdraft facility at an interest rate of 3% per year. This overdraft currently stands at $550,000. Required: A. Calculate the annual holding and ordering cost of Dastico's current inventory management system. B. Calculate the financial effects of adapting the economic order quantity as the basis for ordering inventory. C. Calculate the financial effects of accepting the bulk order discount. D. Recommend with justification which option should be selected by Dastico.
Okay, thank you very much.
Welcome.
Okay, so currently, you see, the order is always placed for the inventory that we want to manage is always the raw material because we are going to producing and be selling. So that one that we don't have problem with that one, but we want to manage the raw material. So the inventory that you'll be using your calculation will be the raw material. It is the raw material that we are buying. We want to manage the cost. Okay, look at this. They said the company produces what? The company produces 750,000 units of product M. So that is a finished good for the company. So what would they be buying? Which product would they be buying? They'll be buying component what? K. The production of 1 unit of product M requires 2 units of what component K. So if their annual production plan is 750, and for every unit that they are producing, they are using 2 units of products of component K. How many of component K would they be buying annually? How many of component K would they be buying annually? So the first thing that you have to do is to find working capital management. Question 1. The first thing that you have to do is to find the annual demand for the raw material. We don't buy the finished goods we are producing. So we want to reduce the cost for what we are buying. So we use the raw material. That will be annual demand. What is the annual demand? What will be the annual demand? From what we are seeing, what will be the annual demand? That will be 1.5 million, isn't it?
Yes.
So
Yes.
750,000 times 2. So that will give us 1.5 million units. So it is this we want to control. Okay. They are saying that you should look at the current position. What is our order size now? How many orders are we placing a year to get the 150,000 units? How many orders are we placing a year? Our orders is 12 orders. Okay. So it means that for us to be able to get the 1.5 million goods, we have to place order for what? For 12 times. The question now is every order, how many units are we getting? That is the question. Every order, how many units are you getting? Okay. So how do we get the order size? You have to calculate the order size also. The order size is the unit per order. So you have to know that your total unit is what? 1.5 million. And they are saying that the total number of orders that you place to get the total number of goods is 12. So how many goods or how many units are you placing or how many units are you receiving per order? Whenever you want to order, how many units are they bringing? Okay. Your order size is calculated as the annual demand. Your order size is calculated as the annual demand over the quantity that you are ordering, which is the economic order quantity over the quantity. Now they are giving you the order size to be 12. How do you find your economic order quantity now. Okay, so this is how the order size is calculated. So we are now looking for, we have the annual demand to be 1.5. We are now looking for the quantity that we are getting per order. The quantity that we are getting per order. That is what we are looking for. So what we have to do is that our quantity per order, which is technically called the economic order quantity, is calculated as, or let me just say quantity. Okay, the economic order quantity has a different meaning, but it's just like the quantity per order. Okay, so we have the quantity will now be the annual demand over the order size. I hope we agree with that. Our quantity will now be calculated as the annual demand over the order size. So that will be this one divided by 12. What are we having? What is our quantity per order? Current position.
125,000.
Okay, 125,000 units. So for any quantity that any order that we are placing right now, it is 125,000 units that we are receiving. So after knowing this particular position, we can now go ahead to do whatever they are asking us to do. Okay. They are saying that we should calculate the annual holding and ordering cost of DASTICO current inventory management system. So this is the current management system for them. So we have to come to the ordering cost. Okay. How do we calculate the ordering cost? Is the number of order multiplied by the cost per order. How do we do that? It is the annual demand divided by the quantity times the what? The ordering cost. So let me just put a CO here. So cost of order. Okay. But we know that this is annual demand is 1.5 million divided by 125, which will technically give us the 12, but I don't want to use the 12. Okay, because this will be this will be useful somewhere. So we are receiving 1.5 million units every time. But we say that anytime that we say they should bring their goods, they are bringing 125. So how many times can they bring the 125 so that we can get the 1.5 million? That is what we call the order size. Okay. So what is the cost of order now? Is 252. Okay. So that will be multiplied by 252. So 12 multiplied by 252, what are we getting? I hope that is correct.
Yes, it's correct.
So let's come to holding cost. How do we calculate the holding cost? How do we calculate the holding cost? The holding cost, we find the average what? Average quantity. So we have the quantity divided by 2, plus if you have any buffer stock. But we don't have any buffer stock in this question. Okay, so the economic order quantity divided by 2, we find the average multiplied by the cost of holding. So this place, the quantity that we are ordering is 125. So every order is 125, and this will be placed maybe equally within the year. So what we do is that we just find the average order, so which is 125,000 divided by 2 times the holding cost. There is no buffer stock. So if there's a buffer stock, we add it to the half of that one and multiply by the holding cost of 0.21. Okay, so the holding cost, we find the average quantity multiplied by the holding cost. But if there is any buffer stock, you see that your ordering size will be higher than the normal size. Your reorder level will be higher than the actual reorder level. So it means that you are keeping another stock as a safety stock, which will be there, whatever be the case will be there. So you will be holding that particular stock no matter what. And that's what we call the buffer stock or the safety stock. So let's come to this one. What is the cost that we are getting over here? 125,000 divided by 2 multiplied by 0.21. I'm getting 13125.
Yes.
Okay. So the holding cost will be 13125. Sometimes the question can ask you to find the total inventory cost. So if they are asking you to find the total inventory cost, then you calculate your holding cost, your ordering cost, then you now add your purchase price because you buy the item. How much are you buying them? 1 unit is 14 what? Pesos. How many units are you buying per year? It is 1.5. So 1.5 multiplied by the 1.5 multiplied by the cost per unit. But this one, the question is specifically asking us to find the holding cost and the ordering cost. So that is what we have done. So you should calculate the annual holding cost and ordering cost of that STICO current inventory management system. So that's what we are doing. But if they should ask you to do the total inventory cost based on the current position, then after calculating the holding and the ordering cost, you will now calculate for the purchase price. You'll be buying 1.5 and each unit is $14. Please, we don't manage the inventory. We don't manage the finished goods. No, we manage the material that we are using to produce the finished goods. So the question will always give, they can give you the finished goods and they will give you the requirements. So you have to calculate the raw material. It is the raw material that you'll be ordering. It is the raw material that you'll be holding, not the finished goods. Okay. So let's come to this particular one. Let's come to this particular one. Okay. So what we'll do is that since the question is asking us to look at the option, there's a discount over here. Then let's calculate the purchase price also. Let's calculate the purchase price for each of them. So this is the holding and this one, but let's look at the total inventory cost under each of the options. So the current position, we are doing this for the current position. The total inventory cost will be the purchase price. Okay, the purchase price is currently 1.5 multiplied by 14. What are we having?
That's 21.
Okay, 21 million, isn't it?
Yes.
Okay. Okay, then we now have the ordering cost. Ordering cost was 30.24. Okay, then you come to the holding cost. That will be 13125. Okay. So that will, if you totally, that will be your total cost under the current position. Let's come to the second one that they are saying that the company wants to use the economic order quantity. So the economic order quantity, we just want to know the number of quantity that we should be ordering per order so that our inventory cost can be minimized. That is what we call the economic order quantity. So what quantity should we place per order? Anytime that we are going to place order, how many quantity should we request so that our total inventory cost will be will be minimized. That is what we call the economic order quantity. So you always have to calculate for the economic order quantity. How do we do that? So using the economic order quantity, we are going to be using the square root of 2 times the annual demand times the ordering cost, all divided by the holding cost. So 2 times the annual demand, which is 1.5 million, times 252 divided by 0.21. Okay, all of this into. So what are you having? Is what are you having? If you put it in your bracket in your calculator, what are you having?
That's 60,000.
No approximation.
Oh,
Okay. So this one you can go another step. Can someone confirm that for us?
Please, it's 60,000.
Okay. So 60,000 units. So currently, our economic order, our quantity that we can order the quantity that we can order for every order or per order to minimize our cost is 60,000. So what will be the position now? What will be the inventory cost now? You now find the purchase price. The purchase price will still be the same because you can see that nothing is going to be changing. You will still buy the 1.5 at 14 cedi. So the purchase price will still be the 21 million. But what is going to be changing now will be the holding and then the ordering cost. Okay, so let's take the ordering cost first. So the ordering cost will now be the annual demand divided by the economic order quantity. Okay, the question is, we are still going to be what? Buying what? 1.5 million. But we are saying that for every order, it is 60 units. So how many orders can we place so that we can be able to get our 1.5 million? We divide by the quantity per order. That is going to give us the number of orders. So multiply by the ordering cost. So this will give us the 1.5 divided by the 60,000 multiplied by 252. What will be the ordering cost?
I'm getting 6,300.
Yeah, 6,300.
Okay. So 6,300. So ordering cost 6,300. Okay. What I want to tell you is that if the quantity per order is reducing, the ordering cost will be increasing because the number of order will also be increasing. But if the quantity that you are purchasing is reducing, the holding cost will be what? Will be reducing because we now be using holding cost will now be 60,000 divided by 2 times 0.21. Okay. So whenever you are using economic order quantity and the quantity per order is reducing, your holding cost will be increasing because it will increase the number of order. But as a holding cost, your ordering cost will be increasing because it will be increasing the number of order. But your holding cost is calculated based on the average. So if you are ordering a lower amount of quantity for every order, it means that your average will also be small and your holding cost will also be small. So that will be 30,000 times 0.2. What are we having?
6,300.
Okay, that will also be 6,300, isn't it? Okay. So what will be our total inventory cost now? What you have to do is that just ignore the total purchase price because it will be the same for the two. The total purchase price will be the same for the two. Nothing is going to be changing. It will be 21 million against 21 million. Nothing is changing. So we only base our calculation on the holding and the ordering cost. So the holding and the ordering cost will be 16,149 under the current position. But if you count to this one, the total cost will now be 6,300 plus 6,300. And that will give us 1,600. So you can see that the holding cost and then this one is now, but these two will be giving you 16149. The purchase price will still be the same for the two. So if you subtract, you get 0. So we don't base the calculation or the recommendation on the purchase price because the purchase price will still be the same. So you can only focus on the order cost. But if the economic order quantity is going to be bringing a discount, then we can now factor in the purchase price. We don't factor in the purchase price if it is going to be the same for the two, because 21 million against 21 million, nothing is changing. So we now focus our recommendation on the order cost. So the ordering and then the holding cost is 161. But if you come over here, it is 126 now. What is happening? What is happening? What will be the financial effect? That is what the question is asking you. The financial effect will be the what? The reduction in the cost. So it will be 161,149 minus 12,600. How much are they saving? If they want to use the economic order quantity, how much will they be saving? They will be saving a cost of 3559. Okay. Let's now count to the other one. Calculate the financial effect of accepting the bulk order discounts. Okay. So they say the bulk order discount, the supplier of component K has offered Dastico a discount of 0.05 on the purchase price of component K, provided that the company orders what? The company orders 250,000 units per order. What is now under the discount? What is now the new order quantity? Under the purchase price, under the discount, what is now the new order quantity for the company?
60,000.
Are you sure?
250,000.
Yes, they are saying that whenever you order, for every order, you should be what? You should be requesting for 250,000 units. If that is the case, we give you a discount. So their order, their quantity per order now will now be what? 250,000. And you can see that they should order 250 per order. So their order quantity now, or their economic order quantity now will be 250,000 under the new one. Okay. Let's now look at what will be the effect of this. So we look at the option 3, which is the bulk discounts. So what will be the effect of this now? Okay. So we now look at our purchase price first, because the purchase price will now be changing. Okay, the purchase price will now be what? Would it be 99.5%? Would the company be paying 99.5% of the purchase price because the discount is 0.5?
Yes, correct.
Okay, so we can say that the amount of the company will be paying now will be 0.95 times the what? The 21 million, isn't it? Okay. So if you like, you can find a discount and subtract it from the amount that they will be paying. Or you now find a new purchase price. Okay. This can also be calculated as this. Okay. So you can also calculate the purchase price as this. You will now find a new price, which is 0.995 net of the discount multiplied by 14, multiplied by the quantity that you are buying. Okay. So what are you getting?
28,950,000.
Okay. Okay. So we have 28,950,000. That will be the new purchase price now. Let's count to. You see, sometimes the question can give you the range. They will say that if the company purchase between, they can give you if the company purchase between. Okay, let me go back to the question. They will give you a range that these people will offer them a discount of this one if the company purchase between the range of 250,000 to 350,000. Please just pick the lowest one. This will be your new order size. The company will now be ordering this one. If they give you a range, pick the least one as a new order size for you. Okay. So let's come to the ordering cost now. We don't have to do any calculation. We only calculate the economic order quantity because we don't know the quantity that we should buy per order. But sometimes the question will give you the quantity per order. So you just take that one as the economic order quantity for them. So the ordering cost will now be annual demand divided by the new economic order quantity multiplied by the cost of order. So the annual demand will still be 1.5, but currently the company will be what? Ordering what? 250,000. So every order is 250,000. How many order can we place before getting the 1.5? Okay, so what will be the number of order?
1512 units.
Okay. I'm getting 6. Oh, I'm getting 6 orders.
Yes.
Okay, multiply by, what are you getting? Okay, the total cost is 1512, isn't it?
Yes, please.
Let's come to the holding cost. The holding cost, what are we going to be having? What will be, how do we calculate it? What are we going to be dividing by the 2? It will be what divided by 2? What quantity are we going to be using?
Economic order
The
quantity.
new quantity,
Which is what?
250,000.
Okay, 250,000 divided by 2 multiplied by 0.12. Okay, so
0.21.
0.21, sorry. Okay, so as I said that if the order size is increasing, or if the order per quantity or the order size is increasing, the ordering cost will be reducing, but your holding cost will be increasing. Look at this one too. You see that the holding cost will be increasing here, but the ordering cost will be reducing. So 250,000 divided by 2 times 0.21. I'm getting 26,250. Okay, let's now calculate the total cost. Okay, the total cost, we can use the holding cost of 26,250. Okay, then we use the ordering cost of 1512. But what will happen is that the discount is going to reduce this one, because we are assuming that the purchase price will be the same for all of them, but the purchase price over here is not the same. You can see that we are enjoying a discount of 0.05. So what will be that discount? What will be the discount over there? Or if you like, you can just add the cost for each of them and compare. But this one, if you add, it is plenty because it's 20 minutes something. So let's just look for the discount that we are enjoying on it and subtract it from that particular figure. So that will be 21 million. We're enjoying a discount of what? What is the discount that the company will be enjoying? 0.05 times 21 million. They are enjoying a discount of 105,000. Okay, so you can see that this portion, this particular one will be better. The discount will be better. The discount will be better. Okay, so the discount will be better. So you just add them. So you can, first of all, you can just ignore the discount over here. Then you just bring your purchase price over here. The purchase price is the 220,895,000. Then you put the two together. You put all of them together. If you come to your economic order quantity, you add the purchase price to it over here, because you will still be buying the 150 at 14 cedis. Then you now compare all of them to see which of them is the one giving you the least cost. So this is the current position. You put them together. The economic order quantity, you put them together. Then if you come here, you put this one also together. You see that the discount will be giving them the better option. So they should go for the discounts. They should go for the discounts. That is the recommendation that you have to give to them. They should go for the discounts. They should go for the discounts. And why they should go for the discounts, you have to tell them. All right.
Brain.
Yes, yeah.
All right, go back to the worksheet. Let me see something. So the second formula for calculating where you were. Yeah, the bulk under the bulk discount. The second formula for calculating the purchase price. No, go back.
Okay, this side.
Under the bulk per year, very good. This second formula, why from the 14 in between the 0.9955
The 14 is the purchase
1.5?
price.
Oh, okay, all right.
Is
Okay,
the purchase price. Okay.
yes, it's true. Okay, thank
So I'm already exhausted. Hey, Charlie. Very easy. How a good one. Let's see. So that is the inventory management. Please, it is likely that they will bring inventory management and it will be on the bulk purchase, or it will be like this. But it will not be the same question. It can be like this. Okay, because it was only once that they have examined the inventory management. They have examined the cash management like 3 times already. The Miller All model, they have examined it like 3 times. The receivables management, they have examined the receivables management, and it was only once that they examine the inventory management. So they can still bring the inventory management, or they will not bring it. Okay, they can still bring this one. So what we will do right now is that I hope we can all prepare cash budget. Okay, but I will just explain that one to you so that we move on. Let's come to question 5. Question 5. So let's take the likely areas. What are the things that they can examine? Okay, please, if you come to the formula sheet over here, this is you see this thing over here. You see your economic order quantity over here. So the economic order quantity will be given to you, which is 1. You can see that what we have done yesterday is this one, the purchasing power parity and the interest power parity. These are the formulas. This is the WACC. So the WACC over here, they factor in preference shares. So I'm saying that whenever you have preference shares, you just put it over there. This is the dividend growth. So the G over here is dividend growth. Okay, this is the cash spread. We know if you're using the Miller All model, we calculate the cash spread. This is the return point. The return point we see is the lower limit plus the 1/3 of the spread. This is the upper limit. The upper limit is the return limit, or is the lower limit plus the spread. Okay, and sometimes they can also ask you to calculate the average balance, and this is what we call the Boamo model. This is the 2 times the annual cash demand over the cost of you financing, or the cost of you selling the instrument, divided by the interest that you'll be earning on the instrument. So it's the same formula that we have been using, and that is what we have over here. So this is the cost of debt. This is the cost of debt irredeemable, taking into consideration the tax rate. So interest into bracket 1 minus t. Okay, this is the cost of redeemable debt. And this is the cost of equity without the dividend model without growth. And this is the cost of equity with growth. You can see that you're having D1 over here. It means that you have already increased the dividend by the growth rate. So you can also have the D into bracket 1 plus the G. This is how we calculate the growth using the trend analysis. This is how we calculate the growth using the Gordon's model, which is the return on the equity plus the retention period, or the retention rate. Okay, the bond yield. Sometimes they will give you a bond. So the bond yield is the interest over the market value. Okay, this particular one is the market value of redeemable debt. This is the market value of irredeemable debt. If you are playing with the equity formula, this is the market value of equity using the dividend valuation model. This is without growth, and this is with growth. Okay, if you count to, this is the ungeared beta. What we did the last time, if the company wants to enter into unrelated projects where they have to use the beta of the proxy company. So we can see that this is the asset beta. We assume that the debt is risk-free. Sometimes they will give you the beta. They will not give you the beta, but they will give you information concerning the beta. So you look at the covariance, or the variance of the market, and the variance of the company. So the question will give you all these things. This is capital asset pricing model. This is the formula. So you can see that this is the capital asset pricing model. These formulas are about risks which you might not be seeing in the exam. This is the official formula. This is the internal rate of return. Okay, so the formula they I've shown you. Let's take the question 5, which is the spread and those ones. So we take the 5 and I'm sure the 5. Okay, so the 5, the B and these ones, they're all the same. We are all going to be using them like all this one. So let's just find the 5. Let's look at the 5A. Then we know that we are okay because these ones are the same thing over here. They are all about the Miller all. So let's take the 5A. Auntie Agnes, take that one for us. So the return, the upper limit, the return point of the cash. Okay.
Question 5B.
A, take the A.
Okay. A. Entity Y uses a bank account for its daily income and expenditures. Each year, it expects income and expenditure to be 3 million Ghana cedis. However, daily cash flows are variable, and the standard deviation of daily cash flows is 2,200 Ghana cedis. The annual interest rate is 5%. If the cash balance goes above a certain level, the entity will buy marketable securities to earn interest on the surplus cash. If the cash balance reaches a minimum level, the entity will sell some marketable securities to obtain more cash. The cost of buying or selling securities is 60 cedis per transaction. Entity Y uses the Miller or cash management model. It has decided that it should have a minimum cash balance of 20,000 Ghana cedis required. Calculate A, the spread between the lower and upper cash limits. B, the upper cash limit. C, the return point.
Okay. So this one they have examined this one like 2 times already, and they can still bring it. So it's very simple. They'll always examine the Miller all. The BOMO is just like the economic order quantity, so they don't really examine that one. Okay, so they are saying that the company is expecting what? Income and expenditure to be what? 300,000. That is the annual what? Annual cash required. So if you are using the BOMO model, that will be the annual cash required. However, daily cash flows are variable, and the standard deviation of the daily cash flow is 2,200. So they will always give you a standard deviation, but we use variance in the calculation. So you have to square the standard deviation because the square root of the variance is the standard deviation. So you have to square the standard deviation to get your variance. The annual interest rate is 5%. If the cash goes above a certain level, the entity will buy a marketable security to earn interest on the surplus cash. If the cash balance reaches a minimum level, the entity will sell some marketable securities to obtain more cash. The cost of buying or selling is what? 60 per transaction. So I won't use my own formula, but I will use the formula that we have on the formula sheet so that you get it. If you go to the exam, you see a question, you can be able to use it. Okay. What is the spread? On the formula sheet, what is the spread over here? Okay. Okay, on the formula sheet, question 5A. On the formula sheet, our spread is calculated as 3 multiplied by 3f s squared over 4. 4, it should be the interest. The 4 should be the interest. So, okay, 4K will be the interest. So that should be the interest. Okay, all exponents 1 over 3. Always is if you are doing it, if you are using our own formula, it will be 3 times the cubic root of this one. So this is a cubic root over here. So what do? You now look at the question to get your figures. So 3 times the F is the transaction cost. What is the transaction cost? The transaction cost is the cost of you buying or selling the what? The marketable instruments. What is the cost of the transaction? The cost of buying or selling. Okay, is 60. Please, this one you are not going to suffer to get the figures. What is the standard deviation? The standard deviation is what? The daily standard deviation is what?
2,200.
2,400. But this will be a square. You square it. Okay. Then divided by 4 times what? The 5% is the what? Is the K is the interest. But you see the interest, how the standard deviation is given, that's how you're also going to do the interest. The standard deviation is daily, so the interest will also be on daily basis. So how the standard deviation is given, that is how the interest will also be calculated. So it means that you are looking for daily what? Spread. So your interest given to you is annually. Interest given is annually, unless otherwise stated. So what you do is that they haven't given you the number of days, so you assume that it's 365 days. So your interest will now be 0.05 divided by 365 days. Okay, all of the answer exponent 3. So you do your spread. Your spread will be 3 times, you do everything in the bracket before that particular one. So let's now look at the interest over there, 0.05 divided by 365 multiplied by 4. Okay, so I'm having 180 times 220 exponent 2 divided by 0.0005479. So all the answer exponent 1/3. So you do everything in this bracket and exponent the answer by 3. Then after that, you multiply the answer by 3. So what are you getting for the bracket? Those who are using calculator. Please, those who are using calculator, what are you having in the brackets? I'm having 81, 87, 12, 100,000 over 0.0005479, all exponent 1/3. Please let's do it and give us the answer first so that we move on.
I'm getting 11,671.5.
671.
0.51.
Okay. So if you multiply by 3, what are you getting?
$35.
014.52.
Okay.
014, not 104.
Okay. 014, all right.
Mm.
014.5. Please, the spread that you have to do everything over here before you multiply the answer by 3. Don't use 3 to multiply the answer before you find the exponent 1/3. You do everything before you multiply the answer by 3. You have to be very careful with that. If not, you'll be getting a wrong answer in the exam. So that is the spread. The next question is what? The spread is a difficult one. The spread is the difficult one. They are asking us for the upper limit. The upper limit. Okay. The upper limit can be called the maximum balance or the maximum point. Okay. So the upper limit is calculated as the lower limit plus the spread. So the lower limit plus the spread. The lower limit will always be given to you in the question. The lower the lower limit will always be given to you in the question, which is the same as the minimum cash balance, which is 20,000. So the minimum cash balance will be the 20,000 plus the spread of 35,104.5. So we'll be having 55, 55,014.5. Okay, so that is the upper limit. Then you now count to the return point. Okay, the return point is the lower limit plus 1/3 of the spread. So 1/3 of the spread. So 1/3 of the spread, you can just come here and pick this answer. That is the 1/3 of the spread. So that will give you 20,000 plus 11,671.5. So 11,671.5. And that will give you 31.
671.5.
671.5. So that is all about and this is how they are going to ask you. They will give you the items, then they will ask you to use the Miller or calculate the spread. The spread is a difficult one. After you calculate the spread, there is nothing difficult again. You just pick the formula. This question can also ask you to calculate the cash requirement using the Balmer model. The Balmer model is 2 times the what? The annual cash times the transaction cost divided by the ordering cost or the percentage of new or the interest. Okay, so you come to the 2 times the annual cash flow given to us. Okay, the question did not ask us, but I just want to draw your attention to how we do the Balmer issues. Okay, so you can see that each year the expenditure is what? 3 million. So that will be the annual cash demand. So 3 million times the transaction cost of what? 60. Okay, all of this divided by the interest rate 0.5. For this one, we don't use the standard deviation, so the interest will be annually. We are doing everything annually. So we are doing everything annually. So the answer that you'll be getting is the economic cash requirements, that whenever you want to request for cash, that is the amount that you should have to request for. Or whenever you want to sell the security, you have to sell this amount of security for you to be able to get your cash requirements. Okay, so that is the Boamo one. We are done with that one. These are the important ones. You can try the B. Those are the important ones. Let's move on to cash flow. Let's see cash. I hope we can all prepare cash budgets. I hope we can all prepare cash budget, isn't it?
Yep.
Okay. But let me see whether I can. It's 9:53. Let me see whether I can deal with this this one. Let me see whether I can deal with the question 3, which is about over trading. Okay, they haven't examined cash budgets, so they can bring a question on cash budgets, and you have to be able to do that. So let's see whether we can do the issue of over trading. Then we just explain the footnote relating to the cash budget, then we move on. Okay, let's look at question 3. Question 3. Auntie Agnes, are you there?
Yes, please. Question 3.
Okay.
Uptown Co. is concerned that it may be overtrading. Financial information relating to the company is as follows.
Okay, so just come to, okay. Company which are similar to this one, evaluate whether the half-time can be considered to be overtrading and discuss how overtrading can be overcome. Okay, we look at the symptoms of what? Overtrading, isn't it? If a company is overtrading, we say that there will be what? There will be, what are the symptoms of overtrading? Okay, let's see whether you can actually remember what we have learned. The first symptom is what? There will be excessive increase in what? Revenue. Revenue will be increasing in a higher proportion, or there will be excessive increase in revenue, or the gross profit margin or the net profit margin is going to be experiencing a massive increase. Okay, so if the revenue is increasing in a margin that is not normal, we say the company might be overtrading. There will also be excessive reliance on what? On bank overdrafts. So the company will be relying on short-term debt than long-term debt. And there will be a small investment in what? In long-term capital. Their liquidity ratios and their current ratios will also be increasing, or they will also be reducing. Their inventory days will also be increasing. Their receivable periods will also be increasing. So what is going to happen is that it will be only the working capital items that will be seeing a massive increase, but the long-term capital will be reducing. First of all, you can tell the examiner what overtrading means. Overtrading means trying to do much with what? A little investment. Trying to increase your revenue at a rate higher than what? The proportional increase that you have done, or the proportional investment that you have done in your long-term capital. So the overtrading, we look at what is happening. The increase in the revenue, is it proportional to the investment that we have in the long term? So we look at the long term. The investment that you are doing in the long-term capital, does it merit the proportionate or the equivalent increase in revenue? You are bringing 100 cedis and you want to make a profit of 500 Ghana cedis. No, you are overtrading. You might be overutilizing your assets, or you might be using other means to increase your revenue. So if you are bringing 500 and you are getting a profit of, you are bringing 100 cedis and you are getting a profit of 500, it means that is not normal. You are getting a return of 5 times of your your investment. That is normal. That is not normal. But if you are bringing 300 Ghana cedis and you are getting a profit of 500 Ghana cedis, that is normal. We can say, oh, that is somehow justifiable. Okay, so overtrading has to do with the investment that you have in the long-term capital. Does it merit the increase or the proportionate increase or the equivalent increase in the revenue? If yes, then we say that you are not overtrading. So we have overtrading and overcapitalization. Overcapitalization is the opposite of overtrading. So what we are going to be using over here to determine whether the company is overtrading is to look at a change in the revenue. What is the change in the revenue? We look at the change in the revenue. Okay. Then you also come and look at the working capital ratios. Okay. You also look at the inventory. There's an increase in the inventory over there. You also look at the increase in receivables. There's 100% increase in the receivables. Let's come to the trade payables over here. The trade payables has also increased. But let's come to overdrafts. Overdraft is experiencing what? More than 100% increase. So you can say the company is relying on what? On overdraft for the activities. If you come to the long-term capital over here, the long-term capital, there is no increase. So this shows that the company is overtrading, because the increase in the revenue should be financed through the what? The long-term what? Capital. But you can see that overdraft is increasing. So you find the change in the overdraft. These are the things that you will find. You find the change in the overdraft. You find the change in the payables. You also find the current ratios for the 2 years. So what will be the current ratio for the 2 years? So you find the current ratio for the 2 years. Okay. So this is how you answer the question. The calculations will be based, the first one will be based on the what? The change in the what? In the revenue. What is the change in the revenue? It will be 1,700 minus 12,000 multiplied by 100. That will give you the change. Then you now come to the change in the inventory or you calculate the inventory days. The question has given you inventory days and trade receivables days and trade payable days. So you can also calculate those things and compare with the what? The industry average and see whether it is more. Okay, so the first one will be the change in the inventory. You calculate the inventory days. You look at the increase in the overdraft, which is more than 100%, and the company is financing its operations through overdraft. That is also a sign of over trading. So let's just pick the one by one. And okay, so this will be the last question that I will solve, and that is the end. Okay. So let's look at the increase in the revenue. Okay. So percentage increase in revenue. Okay. So that will be 17,100. 17,100 minus 12,000 divided by 12,000. Growth is calculated at the difference between the two divided by initial multiplied by 100. What are you getting?
43%.
Okay, 43%. Let's now come to the increase in the inventory. What is the increase in the bank overdraft? The percentage increase in the bank overdraft. So let's look at that. Overdraft was 850. Now it's what? Overdraft was what? It was first 850. Now it is 2,400. So what is the increase in it? So it be to be 2,400 minus
Yes.
850 divided by 850 times 100. What is the increase in the overdraft? The person who is mentioning the thing to me is now making call. Auntie Agnes, what is the increase in the overdraft?
It's 182.
182%.
Okay, 1286. Okay, so you can also use the increase in the long term. There is no increase in the long term. So you now look at, you can also calculate the increase in the payables. Okay, you can also calculate the increase in the receivables. Okay, so you can calculate the increase in receivables. That will give you 100% increase. Okay, since they have given you some ratios for the similar company, you can calculate the inventory days for the company, the receivable days, the trade payable days, the current ratio, the quick ratio, and see whether their figure that they are having is more than this one. If it is more than this one, they are also overtrading. But if these figures are not given to you, you just look for the indications of a company overtrading. The first one will be the revenue, increase in the revenue. There will be a massive increase in the revenue with what? A lower increase in the what? In the long-term capital. There is no increase in the long-term capital. It means that the company is relying on their short-term what? Finance. Most specifically the overdrafts. Okay. Then you also look at their current ratio. What is the current ratio for the first year? The current ratio for the first year will be 3,100 divided by what? 3,100 divided by 2,100. 1.47. Okay. That will be 1.47, which is 3,100 divided by 2,100, all is to 1. Okay. Let's count to this year now. It will be 4,500 divided by 4,300. This will be less than what? This will be less than 1. So this is also a sign. If there's a deterioration in the current ratio, it's a sign that the company is overtrading. So the deterioration in the current ratio is also a sign that the company is overtrading. So the increase in the revenue does not match the increase in the long-term capital. There is no increase in the long-term capital. It means that the company is now relying on what? The overdraft, heavily on the overdraft. So the heavy reliance on the overdraft is a sign that the company is overtrading. The deterioration in the current ratio, which is 1.47 to what? A different ratio now, is also a sign that the company is overtrading. Overtrading means that there will be a lot of investment in the current assets and the current liabilities. Much of the investment will be coming from the current items, not the long-term items. That's what we call the companies overtrading. So the company will be experiencing an increase, a lot of increase in the current asset and in the current liabilities. And there will be a small increase in the long-term capital. If that is the case, we say that the company is overtrading. So what are the things that you have to look for? The increase in the revenue, does it match with the increase in the long-term capital? Is there any higher increase in the overdraft? What is the current ratio? What is the quick ratio? What is the working capital? Is the working capital reducing? If that is the case, it means that the company is financing most of its operations through the current liabilities. So those are the things that you'll be saying. But since they have given you a corresponding items for a similar company, you can also calculate the inventory days, the trade days, the trade receivable days, the trade payable days, and compare with the what the company is having, and see if the company is overtrading. So the overtrading, they are actually overtrading because of the increase in the revenue. The revenue is experiencing 43.1 or 43% increase, but a zero increase in the long-term capital. This means that the revenue is increasing a proportion higher than what the long-term capital. The increase in the revenue should be as a result of the increase in what in the long-term capital. So that is a sign that the company is overtrading. You also count the overdraft. The company is relying heavily on the overdraft. Why? The overdraft has experienced a more than 100% increase, with no increase in the long-term capital. So the company is using solely the overdraft to finance its operations. You also look at the receivables. The receivables has also experienced a 100% increase from 1,000 to 2,000. Then you also take some of the ratios over here. The inventory days compared to the industry. What is the company having and what is the industry is having? And those are the things that you'll be looking at. So the increase in the receivables is a sign that the company is overtrading. The items or the increase in the revenue should not be as a result of increase in the short-term items. It should be as a result of increase in the long-term capital. So that is how we look at it. All right. So, seniors, if you don't have any problem, look at the cash flow questions yourself. If you have any problem, you can just send me a message on WhatsApp so that we take it from there. Okay. So this one is not, this particular question is not a difficult question, but you can look at it and okay. So that is that. If you don't have any question, I would like to leave you people here so that you can go and do whatever you want to do in the exam hall. We have done our part. You also go and do your part. Thank you all for coming. If you don't have anything for me, I wish you guys all the best. May the good Lord be with you and see you through. Thank you all. I'm very grateful.
Thank you very much.
We are equally grateful here.
Okay.
Yes.
God bless you so much.
Thank you, Lionel. God bless you.
Thank you.